Hello guys, so starting with a revision on our share capital chapter, we've completed the entire chapter. We've seen a lot of numerical questions, especially in this chapter. We've done a lot of practical examples as well. We've done cumulative revisions as well. So by now you would be sort of comfortable with this chapter, but still let me revise the whole chapter once again for you so that you have all the concepts in one place, and then comfortably we'll move on to the next chapter. So we had started this chapter with some very basic points, like for example we had discussed about shares and debentures. We said that shares represent ownership interest, whereas debentures represent lender's interest. Then we discussed that the total share capital of the company, both equity and preference put together, the total share capital of the company is divided into small units, and each unit is called as a share. So share is nothing but small units of the share capital, and share also includes stock. Then we had learnt about what is the meaning of stock. We said stock is nothing but a bundle of fully paid up shares. So stock is nothing but a bundle of fully paid up shares. Then we had learnt about the differentiation between shares and stock. We said when I talk about shares, I talk in numbers. Like I'll say give me 5 shares or give me 10 shares. But when I talk about stock, I'll talk in amount. Like give me stock for 1000 rupees or give me stock for 10,000 rupees. That was the first difference. Second difference, originally company will issue shares only. Company can't originally issue stock. Originally it will be shares only. Later if the shares are fully paid up, if the company thinks it is required, it will be converted into stock. Then third difference, we had learnt that whenever the company is issuing shares, the shares may be fully paid up or the shares may be partly paid up, but only fully paid up shares can be converted into stock. So stock will always be fully paid up. And then we learned shares, like for example if MRF share price is so high and if I can't afford it, can I buy half of a share? No, we cannot buy or sell shares in fractions, but stock, yes, we can buy or sell in fractions also. Then we had learnt about two case laws relating to the basics of share capital. One was New London and Brazilian Bank versus Brockle Bank, wherein it was decided that share is not money, it is interest which is measured in money. And then we have Borland's Trustee versus Steel Brothers and Company Limited, the same case law which we had also learned in the MOA AOA chapter. So this case law says that between the company and the shareholders there are mutual covenants, which means there are rights and duties of members to the company and there are rights and duties of the company to the members. So there are mutual covenants between the company and the shareholders, and where are they written, guys? Where are these mutual covenants written? Where are these rights and duties written? In two places, in Companies Act and in the AOA. Then we learned about the different types of capital. This was covered in section 43. Section 43 says that there are two kinds of capital, equity and preference. But here we had learnt a formula. We said that if the company happens to be a private company and if it is mentioned in the MOA or AOA of the company, then to this company section 43 will not apply, which means these kind of companies can have their own kinds of capital, guys. They can have a third kind of capital, a fourth, fifth, sixth kind. For them, they have their own creativity, they have their own freedom. These kind of companies, they are not bound by section 43. They can have any kind of capital. But generally, section 43, whenever it applies, section 43 says that there are two kinds of capital, equity and preference. Equity capital is also called as ordinary capital, also called as common capital, and equity shares can be of two types: your normal equity shares wherein which carry the same voting rights, or equity shares with differential rights. So this part, equity shares, we'll discuss a little later. Let's focus on preference share capital first. Preference shareholders enjoy two preferential rights, guys. Number one, whenever the company declares dividend, the company will first pay preference dividend at the fixed rate, and only then the company will pay equity dividend, guys. Similarly, whenever the company goes into winding up, one of the steps in winding up is liquidation. In the liquidation step, whatever assets the company has, company will utilize the assets to repay the liabilities. Even after repaying the liabilities, if the company is still left with assets, first of all we call them as surplus assets. The company will use the surplus assets to first repay the preference share capital. Only after repaying preference share capital, if the company is still left with surplus assets, only the balance surplus assets will be to repay the equity capital. So preference shareholders enjoy two preferences. Number one, preference dividend is paid to them first, and number two, they get repayment of preference capital first. Then we spoke about the different kinds of preference shares. First of all, we spoke about participating and non-participating preference shares. Let's talk about participating preference shares first. These participating preference shares, guys, they are preference shares. So therefore, definitely they will enjoy these two benefits. They'll anyways enjoy. Apart from these two preferences, participating preference shares enjoy extra benefit. What is this extra benefit? Extra benefit means they anyways have these two preferences. In addition to that, they have two extra benefits. What are these extra benefits? Number one, whenever the company declares dividend, okay, the company will first pay preference dividend at the fixed rate, then the company will pay equity dividend at a certain rate. Generally, entire balance profits are for the equity shareholders only. But if the preference shares are participating preference shares, in the surplus profits of the company, the equity shareholders will anyways participate, participate, the participating preference shareholders will also participate. So participating preference shares are getting an extra right. Not only will they get fixed preference dividend, but they will also participate along with the equity shareholders in the surplus profits. Similarly, when the company is winding up, when the company has surplus assets, company will first repay preference capital, then the company will repay equity capital. Generally, the entire balance surplus assets, after paying the preference capital, the entire balance surplus assets are for the equity shareholders only. But if the preference shares are participating preference shares, once a preference capital is repaid, once a equity capital is repaid, if the company is still having any surplus assets, in that equity shareholders will anyways participate. Even the participating preference shareholders will participate. So participating preference shareholders, to conclude, they have two extra rights, and that is they participate along with the equity shareholders in the surplus profits of the company. They participate along with the equity shareholder in the surplus assets of the company. Okay, but however, what about non-participating preference shares, guys? They will not have extra right, which means they just have to be satisfied with their preference dividend and with repayment of preference capital. Non-participating preference shares will not participate with the equity shareholders in the extra profits and extra assets. Okay, but what if nothing is mentioned? If nothing is mentioned, by default all preference shares, by default they are non-participating preference shares. This was held in the case of Scottish Insurance Corporation Limited versus Wilsons and Clyde Coal Company Limited, that by default preference shares are always non-participating only. Then we learned about cumulative and non-cumulative preference shares. The word cumulative comes from the word accumulate. Cumulative comes from the word accumulate. And what does accumulate mean, guys? Accumulate here refers to, in case company did not pay preference dividend in one particular year, let us say company was having losses, it didn't pay preference dividend. So company is having arrears of preference dividend, guys. Now if the preference shares are cumulative preference shares, this arrears of preference dividend will keep getting accumulated, which means we will wait and see that in the future, some year at least company will make profit. So in the subsequent year, when the company makes profit, that profit will be used to first repay this arrears of dividend of the earlier years. So if the preference shares are cumulative preference shares, and if the company did not pay preference dividend in 1 year, the shareholders are not worried, because the arrears of dividend will keep getting accumulated, hoping that in the subsequent year when the company makes profit, that profit will be used to pay off this arrears of dividend. But however, if your preference shares are non-cumulative preference shares, non-cumulative indicates that here the arrears of dividend will not accumulate. In non-cumulative preference shares, if the company did not pay preference dividend, that's all, guys. The arrears of dividend will simply lapse. There is no question of accumulating, no question of paying later and all. If the preference shares are non-cumulative preference shares, arrears of preference dividend will simply lapse. Now again the same question arises, what if nothing is mentioned? If nothing is mentioned, then preference shares will be considered to be cumulative only. By default, preference shares are cumulative, and this was held in the case of Staples versus Eastman Photographic Material Company Limited. Then we discussed that there are two more types of preference shares, redeemable and irredeemable, but companies are prohibited from issuing irredeemable preference shares. So preference shares will always be redeemable only. This we'll cover a little later in section 55, guys. Then we discussed that if the company wants to issue preference shares, then three conditions have to be fulfilled. Condition number 1, it has to be authorized in the AOA. Condition 2, to issue preference shareholders, to issue preference shares, we don't need permission of preference shareholders. To issue preference shares, we need permission of our equity shareholders. A prior special resolution is required. And the third condition is that there should not be any subsisting default relating to preference shares or payment of preference dividend. There should not be any subsisting default. Here I had explained to you the significance of the word subsisting. Subsisting means today when the company is issuing preference shares, today defaults should not be existing. In the past, if defaults were existing and if the company has rectified those defaults, then today company can issue preference shares. There should not be any subsisting default, means today default should not be existing. If in the past there was a default and if it got rectified, then not a problem, company can issue preference shares. So come on guys, once again, what are the three conditions? Condition number 1, if the company wants to issue preference shares, it should be authorized by AOA. Number 2, we need permission of our equity shareholders in the form of an SR. And number 3, there should not be any subsisting default relating to redemption of preference shares and payment of preference dividend. Okay, these were 3 conditions. Then under preference share capital, one more point we had learned, can the company have just preference share capital? No, company needs to have equity capital. So either company can have just equity capital or company can have equity plus preference both. But can the company have just a preference? No, that is not allowed. So this was a discussion relating to preference shares, guys. We spoke about the 2 preferential rights that they enjoy. We spoke about the different types of preference shares, the 3 conditions, and can the company have only preference share capital? We discussed no. Company, you need to have both. Either you need to have both equity and preference, or you need to have just equity. But can the company have just a preference? No, that is not allowed. Alright guys, now coming to our discussion on equity shares. So we've completed discussion on preference shares. Talking about equity shares now, we just learned that equity shares are of two types. Either they may have the same voting rights or they may have some differential rights. Now when I say differential rights, the different rights are relating to what? The differential rights may be different rights relating to either voting or dividend or both. Now there is one misunderstanding which students generally have over here. Students think that equity shares with differential rights means they are getting less voting right. It is not necessary guys. Equity shares with differential rights means that these shareholders, their voting rights and their dividend rights are different. Now different can mean more also, different can mean less also. So equity shareholders with differential rights means shareholders where they are having different rights. The voting right and the dividend right is different. Can be less also, can be more also. It is not necessary that equity shares with differential rights will always have less voting right only. It is not necessary. They can have more voting right also, because different means less also, more also. Right guys, so if the company wants to issue equity shares with differential rights, 7 conditions have to be fulfilled. The first condition is that it has to be authorized by AOA. The second condition is that we need the permission of our existing equity shareholders in the form of an ordinary resolution. If the company is a listed company, this OR will be passed by way of postal ballot. If it's an unlisted company, this OR will be passed at the meeting. Then we discussed that these equity shares with differential rights, maximum they can have only 74% of the total voting power. It cannot be more than 74%. We had also discussed the reason for this. We discussed that if it becomes 75%, then equity shares with differential rights, they alone will be able to pass SR. Remember, but we don't want to give these shares power that they themselves can pass SR. That much power we don't want to give them. So that is why they cannot have 75% voting power. They can have maximum 74% voting power only. Then our fourth condition was this one. We said that we will look at the last 3 years. In the last 3 years, financial statement, annual return. Company in the last 3 years, in each of the 3 years, at least one you file. In each of the 3 years, at least one has to be filed guys. Like for example, in this case, at least one is filed in each year guys. Then in year 4, company can issue equity shares with differential rights. In the last 3 years, if there is any year in which company has neither filed financial statements nor filed annual return, then gone, in year 4 company you can't issue differential rights shares. So the fourth condition says, company listen, we will see last 3 years. In last 3 years, each year financial statement or annual return, at least one you file. In the last 3 years, if there is a year in which you have not filed both, then in year 4 you cannot issue equity shares with differential rights. Then my fifth condition was, again I will look at the last 3 years. Company should not have been penalized for any offence relating to SEBI Act, SCRA, FEMA and RBI Act. And then we said the sixth point. In the sixth point we said, company, please don't commit defaults. What defaults guys? Company, you should not default in repayment of term loan to 3 people: public financial institution, PFI, SFI and scheduled bank. And company, you should also not default in paying interest on these loans. You should not default in statutory payment relating to employees. You should not default in payments to be made to IEPF, and you should not default in preference dividend. Totally 5 things. There should not be any default in repayment of term loan to PFI, SFI and scheduled banks, interest on the term loans, then statutory payments relating to employees, amount to be credited to IPF, and lastly preference dividend. What if there is a default? Company listen, if there is a default, you can't issue equity shares with differential rights. You first rectify the default. After rectifying also, immediately you can't issue these shares. After rectifying, we will see what is the end of the financial year of rectification. To that date, we will add 5 years. Till that date, you can't issue equity shares with differential rights. Only after that, you can issue equity shares with differential rights. Which means, company, if you've committed this default, you can't issue equity shares with differential rights. You first rectify, and after rectifying, we'll see what was the year in which the rectification happened. What is the end of the year plus 5 years. Till then, company cannot issue equity shares with differential rights. After that only company can issue. Point to be noted guys, 5 years are calculated not from the date of rectification, but 5 years are calculated from the end of the year of rectification. Okay, so but don't forget, here 3 years, but here 5 years. Okay, and the last point, there should not be any subsisting default. You know what is subsisting default? There should not be any existing default relating to D for dividend, D for deposits, D for debentures. Wherever we talk about debentures, we'll also talk about preference shares. So there should not be any subsisting default relating to payment of dividend, relating to repayment of deposits, redemption of debentures and redemption of preference shares. Totally there are 7 conditions guys. Company, you have to fulfill all the 7 conditions, only then you can issue equity shares with differential rights. Then we learned, if the company is issuing equity shares with differential rights, and to these shareholders, if the company is announcing bonus shares or rights shares, even bonus shares and rights shares will be of the same class, which means even they will carry differential rights. Then the company cannot convert normal shares into differential shares and differential shares into normal shares. That conversion is not allowed. Then proper disclosure has to be made in the board report about this issue. And when the company is maintaining the register of members under section 88, in that register of members all the particulars about these kind of shareholders also has to be written. So this was a discussion regarding equity shares with differential rights. Now comes our next section, guys, section 47, a very important section but a very simple section, the section which talks about voting right of shareholders. Now my shareholders are of two types, equity shareholders and preference shareholders. Preference shareholders generally they don't get voting right. Preference shareholders can vote only in these 4 cases. What are the 4 cases? Number 1, all the matters which directly affect their right. Matters which directly affect their rights. For example, if I am going to change preference dividend rate, or if I am going to change the redemption period of the preference shares, I am coming up with a matter which is going to directly affect the preference shareholders' rights. So in these cases, I will give preference shareholders the voting right. Then in winding up resolutions, equity shareholders also can vote, preference shareholders also can vote. Similarly, in reduction of capital, remember guys, reduction of capital, section 66. If in section 66, an SR has to be passed, remember. To pass this SR, we had learnt in section 66 as well, to pass this SR, equity shareholders, preference shareholders, both will vote, guys. And lastly, we discussed if for the last 2 years continuously, if the company has not paid any preference dividend for last 2 years continuously, then thereafter we will start treating the preference shareholders as if they are equity shareholders. That is, just like how equity shareholders can vote on all resolutions, similarly even preference shareholders in such cases can vote on all resolutions. Understanding? So preference shareholders generally, do they have voting right? No, but they do have voting right in 4 cases. What are the 4 cases? Number 1, all those matters which directly affect the rights of the preference shareholders. Number 2, matters relating to winding up of the company. Number 3, in reduction of capital resolutions. And number 4, if preference dividend has not been paid for 2 years continuously, then preference shareholders can vote just like equity shareholders on all resolutions. Then we discussed that if there is a matter on which equity shareholders and preference shareholders both have voting right, then both will share voting right in the same ratio in which equity share capital is to preference share capital. Guys, I hope you remember in this part especially we had done multiple numerical questions. If you remember, even that Sarvodaya Nidhi Company Limited, even that we had done, guys. I'll repeat once again, like for example, let us say there is a company which has equity share capital of 12 lakh rupees, okay, and it has preference share capital of 3 lakh rupees. Now what I'm telling you over here is in amounts. So 3 lakh rupees of preference share capital and 12 lakh rupees of equity share capital. Now if I am a shareholder, having 1,20,000 rupees of equity share capital, total equity share capital is 12 lakh and I am having 1,20,000 rupees of equity share capital. So my voting right is going to be 10%, guys. So if only the equity shareholders are going to vote, then my voting power is going to be 10%. But let's say there's a matter where both are having voting right. If both are having voting right, my voting percentage will reduce. If only equity shareholders are voting, I have 10% voting right. But if both will vote, then my voting power will reduce, guys, because we equity shareholders will now have to share our voting power with preference shareholders also. So our voting power will reduce. But it will be reducing in what ratio? See, if both are voting, the ratio of the votes will be in the same ratio that equity share capital is to preference share capital, that is 12:3, that is 4:1, guys. This indicates if only equity shareholders are voting, I am going to have 10% voting power in my example. But however, if equity and preference both are voting, then my voting percentage will reduce 10% into 4/5. That is, my voting percentage will now become 8%. So my voting percentage will be in the same ratio in which equity share capital is to preference share capital. Understanding? If only the equity shareholders are voting, I am having 10% shares of the company. So I'll have 10% voting power. But if equity and preference both are voting, then my voting power will reduce, because now equity shareholders have to share their voting power with preference shareholders also. So it will reduce and it will be in the same ratio in which equity share capital is to preference share capital, which means over here in the ratio 4:1. So 10% into 4/5, I simply applied the ratio, guys. If there's a matter in which equity and preference both are having voting right, then my voting power will be 8% only. Okay, then we spoke about equity shareholders. They can vote on every resolution. If voting is by poll, each share will get 1 vote. vote, which means more the number of shares I have, more the number of votes I will get. But if voting is by show of hand, then one member will get only one vote. Then we discussed if calls are in arrear, I am still a member of the company, so I will still get voting right. But in the AOA, if it is mentioned no voting right, then no voting right. But if calls are in advance, will I get any extra voting right? No extra voting right and all. And we also discussed if the company is a Nidhi company, over here a shareholder can have maximum how much voting right. In Nidhi companies, a shareholder can have maximum 5% voting power only. Try to recall Sarvodaya Nidhi Urban Company Limited. Please mark that question. You have to see that question before your examination as well. Then we discussed about variation of shareholders' rights. Section 48 we learnt about. In section 48, what happens is we are saying that company will have multiple classes of shares, guys, like equity shares fully paid up, equity shares 9 rupees paid up, equity shares 6 rupees paid up, differential rights shares 6% preference shares, 10% preference shares. Like this, company will have different classes of shares. Now each class of shares will have its own rights. The company wants to vary the rights of one particular class alone. What does the company want to do? Company wants to change the rights of one particular class alone. So first of all, we'll have to check that does the company have the right to vary or not. And where will we check that, guys? First, we will look at MOA and AOA. Try to recall your keywords. We will check does MOA, AOA, does it allow variation or not? If it allows variation, you can straight away go to step 2, guys. But if it doesn't allow variation, then you will not lose hope. You will look at the terms of issue. Terms of issue, what's a keyword? You will see does the terms of issue prohibit variation. If it prohibits variation, then you can't vary company. But if it is not prohibiting, then you can vary. So remember the keywords. I will first look at MOA, AOA. Does it allow variation? If it allows variation, I'll straight away go to step 2. But if MOA, AOA is not allowing variation, then I will look at the terms of issue. Terms of issue, does it prohibit the variation? If it prohibits the variation, then we can't vary. But if it doesn't prohibit the variation, then we will go to step 2. Now in step 2, listen, if you want to vary the rights of shareholders of one particular class, of course we need their permission, guys. So company has two options. Option 1, company can call a separate meeting of just those shareholders whose rights the company is going to vary, and company can ask them to pass a special resolution. Or option 2, company can ask the shareholders, no need to come for the meeting, stay where you are, just send me written consent. In that case, we need written consent of shareholders who are holding at least 3/4 of the shares of that particular class. So once we conclude that the company can vary, now we come to step 2. In step 2, company needs permission of the shareholders. Which shareholders? Only those shareholders whose rights we are going to vary. How many options company has? 2 options. Option 1, company can call a separate meeting of just those shareholders whose rights the company wants to vary, and company can ask them to pass an SR. Or company can ask for a written consent of just those shareholders whose rights the company can vary. What's the difference between these two? In the first option, we are asking the shareholders to come for the meeting and here pass the SR. In the second option, no meeting and all. We are not calling any meeting. We are telling the shareholders, stay at home, just send us written consent. Okay guys, then sometimes what happens is that, let's say there's a class of shareholders and they're passing a resolution to vary their rights. Understandable, go ahead, you can do it. But sometimes what happens is this class is passing a resolution because of which the rights of another class will also get affected. So if that happens, of course we need the permission of this other class also. In simple words, if the shareholders are passing a resolution to affect their rights, which will also end up changing the rights of another class, then we have to get permission of that other class also. Now listen, let us say company was eligible to vary the rights. Then company, asked the shareholders to pass this resolution and all that also was done. Resolution was passed, company varied the rights. But still, some shareholders will agree for the resolution, some shareholders will not agree, guys. The shareholders who vote in favor, they are called as the consenting shareholders, but the shareholders who voted against the resolution, they are called as dissenting shareholders, guys. So even though some shareholders voted against, but because SR was passed, because we got consent from shareholders holding 3/4 of the shares of that particular class, company will go ahead with the variation. But what about the dissenting shareholders? If the dissenting shareholders, the shareholders who are not okay with the variation, put together, if they are holding at least 10% shares of the company, then these dissenting shareholders, they will go to whom? They will go to NCLT. When will they go to NCLT? Within 21 days. Within 21 days from when? Within 21 days from the date of resolution. And what will they go to the NCLT and do? They will file an application. What application? Requesting NCLT, please cancel the variation. Then we learned as soon as they go to the NCLT, immediately company will have to pass the whole variation. We'll have to wait and see when does the NCLT pass an order. If the NCLT passes an order saying company you can go ahead with variation, then we will resume the variation. But if NCLT passes an order company cancel the variation, no option, we'll have to cancel the variation. Here we had learned two more keywords. We said NCLT's order will be binding and final, and whatever order NCLT passes, that order has to be filed with ROC also within 30 days. So this was the power given to dissenting shareholders, but dissenting shareholders will have this power only if put together they are holding at least 10% of the shares of that particular class. Then we learned that this whole section 48 will not apply in three cases. If it is cancellation of shares, we have a separate section altogether, section 61. Apply that, don't apply section 48. Similarly, if it's a case of reduction of share capital, we have a separate section for that, section 66. Apply that, don't apply section 48. And this was very interesting. You remember, if the company is issuing more preference shares, yes, it will affect the existing preference shareholders, but do we get their consent, guys, to issue preference shares in the company? No. So even if the company is issuing more preference shares, even if they are pari passu, even if they are equal to the existing preference shareholders, even if existing preference shareholders will be affected because of the issue of more preference shares, still this doesn't come under variation. We don't need the permission of the existing preference shareholders. We only need SR from the equity shareholders. Right, guys? So this was section 48. Section 48, remember the steps? First of all, we have to check whether the company has the right to vary or not. How will we check that? We'll check in the MOA AOA, does it allow variation? If it allows variation, great, company will go ahead and vary. But if it doesn't allow variation, we will not lose hope. We will look at the terms of issue, does it prohibit variation? If it prohibits variation, company you can't vary. If it doesn't prohibit variation, company you can vary. Welcome to step 2. In step 2, we will ask permission from the shareholders of that particular class whose rights we want to vary. We have two options, either call a meeting and ask them to pass SR, or no, don't come for meeting, stay where you are, stay at home, just to send written consent. Then we learned because of this variation, if another class will also get affected, then we need consent of that other class also. And lastly, we learned about dissenting shareholders. Dissenting shareholders alone, will you answer correctly once again? Come on, guys, let's do like a rapid fire question round. I'll keep asking questions, you keep giving answers. Dissenting shareholders, question number 1, dissenting shareholders should hold how many shares? They should hold at least 10% of the shares of that particular class. They will go to whom? NCLT. Within how many days? 21 days. 21 days from what? 21 days from passing the special resolution. And what will they do with NCLT? They will file an application. What application? Application to cancel the variation. As soon as they go to NCLT, what will happen to the company? Company will have to pause the variation. We'll have to wait and see what order NCLT passes. If NCLT passes an order allowing the company to continue with the variation, then we will resume. We'll go ahead with the variation. But if NCLT passes an order asking the company to cancel the variation, then we'll have to cancel the variation. And tell me the two keywords. NCLT's order will be binding and final. And lastly, NCLT's order has to be filed with whom? ROC. Within how many days? Within 30 days. Story over, guys. This was section 48. Then we learned about section 49, which spoke about calls on shares. Here we had only one important point, which was about uniform basis. We'll come to that. Let's go point by point. First of all, in section 49, calls on shares, we know the meaning of calls, guys. Like for example, if it is a 10 rupees share but only 6 rupees is paid up, then shareholders still have the liability to pay 4 rupees. So when will the shareholders pay this money, guys? Whenever the company makes a share call. Share call is nothing but a demand which the company is making, asking the shareholders to pay this balance 4 rupees. Now here there are two options. Either the company can make a call, either the company can demand the entire 4 rupees, or the company can demand even a part of it. So share call is nothing but a demand made by the company asking the shareholders to pay the whole or part of the balance amount remaining unpaid on the shares. Okay, now listen, this share call, when can the company make this share call? At any time during the continuance of the company. We discussed even in winding up process, company is still existing. So that time also company can make a share call. But once a company is wound up, after that share call cannot be made. Till the company is existing, till then share call can be made. Then we learned company, whenever you make a share call, please make the share call on a uniform basis, which means in one particular class, if there are 10 shareholders, you can't ask one shareholder alone to pay 4 rupees and other shareholders to pay 2 rupees. Like that, it is not allowed. All the shares which are belonging to one particular class, a uniform call has to be made, which means all the shares belonging to one particular class, the same share call only has to be made. Here we had an important case law, guys, Galloway versus Hall Concert Society. Just because the directors are fed up of one particular shareholder, we can't ask him alone to pay the entire amount. See, if that one particular shareholder shareholder is belonging to a separate class altogether, then okay, we can make a separate share call. But if in his class there are other shareholders also, then all the shares belonging to that particular class, uniform call has to be made. Then we learned that whenever the company makes a share call, it's an indivisible debt. In simple words, whenever the company makes a share call, now the shareholder owes that money to the company, guys. Like for example, if the company is asking the shareholder to pay 10 rupees, okay, now the shareholder owes 10 rupees to the company. Out of the 10 rupees, let's say the shareholder is paying 6 rupees, he is paying to the company. That time, can the company say, no, pay 10 rupees or don't pay anything at all? No, the company cannot say that. Company, listen, whatever the shareholder is giving you, accept. You asked him for 10 rupees. He owes you 10 rupees. If he is giving you 6 rupees, you accept 6 rupees. Okay, fine, call the balance 4 as calls in arrear. But accept whatever he is paying, accept that at least, because calls are indivisible debt. Then we learned who makes the share call, who decides when to call, who decides how much to call. All this decision is made by board of directors. It's a huge power that they have. They can decide when to make the share call, for how much money to call, all that they can decide. But board of directors, please exercise this power only in the best interest of the company we discussed. And company can make any number of share calls. And remember, we spoke about one extra point. We spoke about call notice also. We discussed whenever the board of directors make this share call on behalf of the company, they will issue a call notice to the shareholders, telling the shareholders what is the time limit within which they have to pay, how much they have to pay. All that information will be put in the call notice, and in the call notice there should not be any mistake also, we had discussed. So this was section number 49, guys, calls on shares. Most important point over here is that calls have to be made on a uniform basis against all the shares of that particular class. Remember the case law, Galloway versus Hall Concert Society. Then we discussed about calls in advance, section 50. First of all, can the company accept calls in advance? Yes, if it is authorized by AOA, company can accept. Now on the calls in advance, will the shareholder get extra voting right? Terrible, no extra voting right and all. Then on the calls in advance, do we have to pay any interest to that shareholder? Yes, if it is authorized by AOA. But what if company is not having any profit? Then can company escape from this interest obligation? No, company. Interest is a charge on your profits, which means if you have profits, pay the interest out of profits. If you don't have profits, you still have to pay this interest, pay out of capital, but you still have to pay. Then shareholder is asking for refund of the advance money. Will we give him a refund? No, shareholder, sorry, calls in advance are not refundable. Calls in advance are not refundable. But however, there is one exception. Remember, when the company goes into winding up, company will first repay the outsiders, then the company will refund the calls in advance, only then the company will repay the capital. So generally calls in advance are not refundable, but they are refundable only in one situation, and that is when the company winds up. When the company winds up, whatever calls in advance money we have, company will refund that, but only after repaying the outsiders. So this was section 50, calls in advance. Company can accept calls in advance? Yes, if it is authorized by AOA. Will company give interest on calls in advance? Yes, if it is provided in the AOA. This interest is a charge on profits, which means if company doesn't have profits, company still has to pay this interest out of capital, and this advance money is not refundable except when the company goes in winding up, and that time also company will first pay the outsiders, only then company will refund the calls in advance, but before repaying the capital. Now coming to our next section, which is section 52. Simple section, guys, talks about issue of shares at a premium. Can we issue shares at a premium? Yes. Is there any limit on how much premium we can collect on the shares? There is no limit. But is there a restriction on what the premium money can be used for? Yes. So shares can be issued at a premium. Above face value, whatever the company collects for the shares, that's called as premium. There's no limit on the premium. It can be how much ever the company wants it to be. But however, once the premium money is collected, what does the company do with the premium money? On that there is a restriction. If the company wants to issue shares at a premium, no AOA authorization is required, guys. Whether AOA is silent, whether AOA authorizes, it doesn't matter. And premium money can be collected in cash also. It can be collected in kind also. Now let's talk about the restrictions. Whatever premium money has been collected, premium money can be used for what purposes? It can be used only for 5 purposes. Number 1, to issue bonus shares. Number 2, to write off preliminary expenses. Number 3, to write off share issue expenses like underwriting commission and all. Number 3, to pay the premium on redemption of preference shares and debentures. Please know that we can use securities premium only to pay the premium on redemption of preference shares and debentures. We can't use a securities premium money to pay the entire amount which is due on redemption. Only the premium on redemption we can take from here. And lastly, we can use money from securities premium account for buyback of shares also. So whatever money is there in securities premium premium account, that money can be used only for these 5 purposes. But if the company falls under the category of prescribed classes of companies whose financial statements have to be as per accounting standards mentioned in section 133, now these kind of companies can use the securities premium money only for 3 purposes: bonus shares, to write off share issue expenses, and for buyback of securities. Got it, guys? Simple section, section 52. Now what will happen if you start using the premium money for other purposes? If the company starts using the premium money for other purposes, it will amount to reduction of capital, and section 66 will come into the picture. Okay, so can the company issue shares at a premium? Yes. Is there any limit on the premium? No. If AOA doesn't authorize, can the company still issue shares at a premium? Yes. Now there's no limit on the premium amount, but once the premium money is collected, company can use that premium money only for these 5 purposes. These 5 purposes we had discussed along with the accounting entries. Remember the journal entries, guys? Keep that in your mind. That will ensure that you never misinterpret the concept. Totally 5 purposes only. Number 1, to issue bonus shares. Number 2, to write off preliminary expenses. Number 3, to meet the share issue expenses. Number 4, when the company is redeeming the preference shares and the debentures, for the entire redemption value, you cannot take the money from securities premium account. You can take money only the premium on redemption from here. Only the premium on redemption can be paid out of this securities premium account. And lastly, we can use this money for buyback of shares also. Okay. Now coming to the next discussion, section 53, discount. Can the company issue shares at a discount? Company, it is prohibited. See, debentures, yes, you can issue at a discount. Bonds, yes, you can issue at a discount. But equity shares, preference shares, these two company cannot issue at a discount. And if the company still issues equity shares or preference shares at a discount, it's going to be void. But guys, there are 2 exceptional cases where company can issue equity shares at a discount. One is sweat equity shares, and the second one only has a lot of keywords. If you remember, in the second one, company is issuing equity shares to creditors under 2 things: SRP, DRS, Statutory Resolution Plan, SRP, DRS, Debt Restructuring Scheme, as per RBI Act or as per Banking Regulation Act. Once again, generally company cannot issue equity shares at a discount, but there are 2 exceptional cases where equity shares can be issued at a discount. Generally, only bonds and debentures can be issued at a discount. Equity shares, preference shares cannot be issued at a discount. If equity or preference shares are issued at a discount, it is considered to be void. But there are 2 exceptional cases where equity shares can be issued at a discount. One is sweat equity shares, and the other is when company is not able to repay creditors. Instead of repaying them in money, company will repay them by issuing equity shares to them. Those equity shares can be issued at a discount provided this whole arrangement is under DRS, Debt Restructuring Scheme, SRP, Statutory Resolution Plan, under RBI Act or as per the Banking Regulation Act. So the second exception, tell me one last time, to whom are we issuing equity shares? To the creditors. Why are we issuing equity shares to them? Because we are not able to repay them. So therefore, instead of repaying in money, we are repaying them by giving them more equity shares. Can those equity shares be at a discount? Yes. This whole arrangement is under dash or dash, SRP or DRS. What is SRP? Statutory Resolution Plan. What is DRS? Debt Restructuring Scheme. Under which act is all this? RBI Act or Banking Regulation Act. Okay, this was section 53, discount. Then comes section 54, guys, sweat equity shares. Now this is important. Here we learned that whenever the company wants to issue sweat equity shares, first of all, what are sweat equity shares? They're equity shares which are issued at a discount or for consideration other than cash. To whom? To directors or employees. Why? What are they giving us in return? 3 things, guys. Either they are giving to us know-how in return, or intellectual property rights in return, or value addition by whatever name called. So in sweat equity shares, company is giving to the employees or company is giving to the directors equity shares either at a discount or for consideration other than cash. And what are the employees or directors giving in return to the company? Either they are giving in return to the company know-how or intellectual property rights or value additions by whatever name called. Now these employees, remember, they can be employees of the company, holding company or subsidiary company, but the employees have to be permanent employees, which means whether they are working in India or outside India, they must be permanent employees. They must not be interns, they must not be employees who are still in probation and all. No, they should be temporary, they should be permanent employees working in India, outside India, doesn't matter. Employees of company, holding company, subsidiary company, doesn't matter. Directors may be whole-time directors, part-time directors, independent, not independent, executive, not executive, it doesn't matter. Directors can be any kind of directors, just that they must be directors of the company, holding company or subsidiary company. Now listen to the next point under sweat equity shares. If the company is issuing sweat equity shares, they should be of a class that is already existing, which means sweat equity shares by itself should not become a separate class altogether. Sweat equity shares should be of a class which is already existing. To issue sweat equity shares, we first need permission of our shareholders, and SR has to be passed. But this SR will have validity period, guys. It will have a validity period of only 12 months. So within 12 months from the date of passing the SR, company should allot the sweat equity shares. And of course, if the company is a listed company, SEBI regulations also have to be followed. Okay, so sweat equity shares should be of a class which is already existing. Prior special resolution has to be passed. Then the special resolution will have a validity period of 12 months. Within 12 months period, the sweat equity shares should be allotted. And if the company is a listed company, SEBI regulations also have to be followed. Then when we were discussing sweat equity shares, if you remember, the most amount that we spent was on this part, that there's a limit. How many sweat equity shares can the company issue? There's a limit. Now the limit depends, that there are two limits. One is a per annum limit and the other is a total overall limit. How many limits, guys? Two limits. One is a per annum limit, the other is a total overall limit. First of all, talking about the per annum limit, in a year, company can issue how many sweat equity shares in a year? 15% of paid up equity share capital or issue value 5 crore, whichever is higher. If you recall, we had spoken a lot about this. This is issue value and not face value. So sweat equity shares in a year we can issue 15% of existing paid up equity share capital or issue value of 5 crore, whichever is higher. But what is the overall limit, guys? What do you mean by overall limit? Company is not going to see, maybe company is issuing sweat equity shares in the current year. There may be a case where even in the past company has issued sweat equity shares. Total, everything put together, what the company has already issued plus what the company is going to issue now, everything put together should be within a certain limit. What is the limit? For startups, the limit is 50% of paid up share capital. For other companies, it is 25% of paid up equity share capital. Right, guys? So here we have to be little careful. The per annum limit is 15% of existing paid up equity share capital or 5 crore, whichever is higher. The overall limit for startups is 50% of paid up share capital. For other companies, it is 25% of paid up equity share capital. Right, guys? So this was our discussion on the limits. Keep in mind, here you have paid up equity share capital. For other companies also paid up equity share capital. For startups alone, it is just paid up share capital, which means for startups, when you're doing this calculation, you will take equity preference both. Okay, then we had discussed about the lock-in period. We said that once a company issues sweat equity shares, they will have the same rights, duties, responsibilities as other shareholders. They will be pari passu with the other shareholders. They will be equal to the other shareholders except one thing, which is that one thing? Lock-in period. Sweat equity shares have a lock-in period of 3 years, which means within the first 3 years, the person to whom the sweat equity shares were given, that person cannot transfer. Lock-in period is 3 years. Then see, don't you think we need to know that company should give the employee how many sweat equity shares? Because see, the shareholders, the existing shareholders of the company, they will want to ensure that company is not unnecessarily giving the employees too many shares also. So that is why we have to get valuation done. The company will go to a registered valuer and get two valuations. Number one, valuation of what we received from the employees. What we received from the employees? Remember, we received 3 things from the employees: know-how, intellectual property rights, value addition. So what is the value of what we received from the employees? For that, we'll go to the registered valuer. We'll also go to the registered valuer to understand what is the value of our shares. On that basis, the company will decide how many sweat equity shares is to be given to the directors and employees. You understood the reason for this, right? Because if we don't get valuation done, if company gives unnecessarily too many shares to directors and employees, existing shareholders will not like it. So therefore, existing shareholders will want to ensure that company is not unnecessarily giving them too many shares. So that is why we have to get a valuation done so that correctly we can calculate how many shares to give. And then we had learned company maintains a separate register of sweat equity shares in form SH3. This register is kept either at the RO or any other place which the board of directors will decide. Whenever the company issues sweat equity shares, details have to be put in the board report. And lastly, we had spoken about the accounting treatment, guys. This is very important. So here we had discussed that sweat equity shares, there can be two possibilities. Possibility number one is that company gave sweat equity shares to the employee, and in return the sweat equity shares gave an asset to the company. The asset may be either either a depreciable asset or an amortizable asset. We use the word depreciable asset for tangible assets. We use the word amortizable for intangible assets. So the first possibility is company gives sweat equity shares to directors and employees, and in return they gave an asset which is depreciable or amortizable. In this case, we will debit the asset account and we will credit share capital, guys. We are crediting share capital because we are issuing shares, and this asset will go to the balance sheet. Okay, but the other possibility is that company is giving sweat equity shares to the directors or employees, and in return we are not getting an asset from them, guys. Company is giving sweat equity shares to the directors or employees, and in return maybe we are getting services from them. In return maybe we are getting services from them, not an asset. In that case, we will treat it like an employee expense, which means we will debit salary account and we will credit share capital, and the salary account will go into the P&L account. So there are two possibilities in the accounting treatment. Either we gave sweat equity shares to the directors and employees, and in return we got an asset, in which case we will put the asset into the balance sheet, or the second possibility is that we give sweat equity shares to our directors and employees, and in return we are not getting an asset. For example, we are getting services. In that case, it will become an employee expense and we will debit it to the P&L. So this was our entire discussion on sweat equity shares, guys. Once again telling you the most important points. Point number 1, the employees have to be permanent employees. Companies employees, holdings employees or subsidiaries employees, doesn't matter, but they have to be permanent employees, which means they should not be employees on probation and all. Directors can be any kind of directors, whole-time directors, part-time directors. We can have executive directors, non-executive directors, doesn't matter. They can be directors of the company, holding company or subsidiary company, doesn't matter. Second important point, sweat equity shares itself cannot be a separate class altogether. Sweat equity shares have to be of a class which is already issued. Then to issue sweat equity shares, before that prior special resolution is to be passed. That special resolution will have a validity period of 12 months. Within 12 months, company should complete the allotment of sweat equity shares. Then remember the limits, guys. What are the limits? Tell me once again. Tell me the limits. Let's put the limits down here once again. What are the limits? We have two limits. Number 1, we have a per annum limit, and number 2, we have overall limit. The per annum limit is how much, guys? The per annum limit is 15% of the existing paid up equity share capital or issue value of rupees 5 crore, whichever is higher. What is the overall limit? Overall limit means whatever sweat equity shares company is issuing now plus sweat equity shares already issued, everything put together should not exceed a certain limit. What is the limit? The limit depends upon are you a startup or are you any other company. For startup, the limit is 50% of paid up share capital, which means both equity and preference we will consider. For other companies, the limit is 25% of paid up equity share capital, which means only equity capital we will consider. And also remember, for startups you have this increased limit only for the first 10 years. And then we discussed that company has to get a valuation done to know how many sweat equity shares exactly we should issue. Sweat equity shares have a lock-in period of 3 years, and then whatever sweat equity shares company has issued, a proper disclosure has to be made in the director's report. Register has to be maintained in form number SH3, and finally we spoke about the accounting treatment. Just know that this accounting treatment part, it's been a long time they have not asked this. So be prepared. Then after this, we learned about section 55, wherein we spoke about redeemable preference shares. Even earlier, even in the revision, we said that preference shares cannot be irredeemable. If the company is issuing preference shares, they have to be redeemable only. And they have to be redeemed within how many years, guys? They have to be redeemed within 20 years. But remember, if the company is issuing preference shares because the company wants to raise money for infrastructure projects, here alone the redemption period can be up to 30 years also. You remember the reason? The reason I gave you was because infrastructure projects have a long gestation period. We spoke about this with examples. So coming again, preference shares have to be redeemed within 20 years. But if the company is issuing preference shares because the company wants to raise money for infrastructure projects, here the redemption period can be up to 30 years also. Okay. But however, the 21st year onwards, company should start redeeming 10% every year. Company should start redeeming. Before redeeming the preference shares, company should ensure that the preference shares are fully paid up. Only then the company can redeem them. Then to redeem the preference shares, company needs money. Company has how many places from where company can take money? 3 places. Number 1, company you can take money out of distributable profits. Number 2, company you can make a fresh issue of shares and take money from that. But you can't take money out of proceeds of earlier issue. You can take money only out of proceeds of fresh issue, or company can take money out of securities premium section 52. But company, listen, you cannot take the entire money from securities premium. Only the premium on redemption, only the extra, only the premium on redemption you can take from securities premium. So company can can take money from how many places? 3 places. Number 1, distributable profits. Number 2, proceeds of fresh issue. And number 3, securities premium. Then we had learnt that we will see from distributable profits alone, we will see how much money the company took. Using that money, how many preference shares did the company redeem? That many preference shares into face value, company will have to transfer into CRR, capital redemption reserve. That capital redemption reserve cannot be used for any other purpose. It can be used only to issue fully paid bonus shares. I hope you remember the whole logic. Mr. Tom, bank, the whole thing we had discussed. We had discussed that if the company is redeeming preference shares without issuing more shares, if the company redeems preference shares by taking money from here, then the total capital in the company reduces. If the total capital in the company reduces, creditors will be unhappy because creditors don't want company to do money only using creditors' money. Creditors want the capital amount to stay intact. So if we redeem preference shares and because of redemption, if the total capital in the company falls, then to reinstate the capital amount, we transfer money into CRR, right guys? But don't forget, do we transfer the entire amount we take from here into CRR? No. We will see how much money we took from here. Using that much money, how many preference shares we redeemed, that many preference shares face value, that is what we will transfer into CRR, capital redemption reserve. Then once we redeem the preference shares, within 30 days we have to inform ROC, which we will study in section 64 later. And then we had also discussed that whenever the company has to redeem preference shares, and if the company doesn't have any money to redeem preference shares, company can redeem preference shares in such cases by issuing further preference shares. These further preference shares should be of what value? Whatever amount is due on redemption plus preference dividend due. But to do this, here what is the company doing? There is no outflow of money for the company. Company has no money. So instead of redeeming the preference shares by giving money, company is redeeming them by giving them more preference shares. So for this company, you first need permission of the preference shareholders. You need consent of preference shareholders holding at least 3/4 of the preference shares, and you also need NCLT's consent. In case there are any dissenting preference shareholders, we have to redeem them in cash forthwith. Immediately we have to redeem them in cash. And if the company does like this, that is instead of redeeming in money, if the company redeems the preference shares by giving more preference shares, it will be considered as if the company has properly redeemed the preference shares. Okay, this was section 55 guys, redemption of preference shares, talking about the most important points. Company cannot issue irredeemable preference shares. They have to be redeemable only, redeemed within 20 years. Infrastructure projects alone can go up to 30 years, but even over the 21st year onwards, we have to start redeeming 10% every year. Only fully paid up shares can be redeemed. To redeem preference shares, company can take money out of distributable profits or proceeds of fresh issue of shares or from securities premium account. But company, if you take money from distributable profits, we will see how much money you took. Using that much money, how many shares you redeemed, that many shares face value will be transferred to CRR. And then company should inform ROC within 30 days after redemption. And lastly guys, this is important. It's been only in May 2022 they had asked this. They've not asked this point ever since then. Remember the main point. What is the point? Company, listen, whenever you're redeeming preference shares, if you don't have money to redeem preference shares, you can redeem the preference shares by giving them more preference shares. For what value? For whatever amount is due on redemption plus preference dividend. For this much amount, we can issue more preference shares with the permission of preference shareholders holding at least 3/4 of the preference shares, and we also need the consent of NCLT. But in case we have dissenting preference shareholders, we have to redeem them forthwith, we have to give them money and redeem them immediately. Then we spoke about section 46, share certificate. Share certificate, first of all we discussed, it is a prima facie evidence of title. Prima facie evidence means it's not a conclusive evidence. It's only a prima facie evidence of title, which means if there's a share certificate which contains my name, your first impression will be that, your first thought will be that, looks like ma'am is a shareholder of the company. So share certificate is a prima facie evidence of title. It's not a conclusive evidence, it's only a prima facie evidence. Then before the company issues share certificate, two things have to be done. Before issuing the share certificate, number one, board resolution has to be passed, and number two, the shareholder has to surrender the letter of allotment to the company. But if fractional coupons are involved, do you remember fractional coupons guys? I told you in merger cases, in demerger cases and all, this concept of fractional coupons comes into the picture. Like for example, let's say upon merger, I am supposed to get 1.25 shares of the merged entity. Now 0.25 shares, how will I get? So the company will give me a coupon for 0.25 shares. Like that, others also will get a coupon. Those coupons will be bought and sold. So let's say there's another person who has coupon for 0.5 share, another person has coupon for 0.10 share, another person has coupon for 0.15 share. So like this, I will accumulate coupons for 1 share, I will submit this coupon to the company, and in return company will give me shares and share certificate. So we had spoken that if the company, if we want share certificate from the company, 2 conditions have to be fulfilled. First of all, board resolution has to be passed. Secondly, the shareholder has to submit to the company letter of allotment or fractional coupons as the case may be. Then what will be written in the share certificate? Share certificate will be first of all in form number SH1. On the share certificate it will be written, what and all will be written? The names of the shareholders, then what is the amount paid up per share, how many shares, all this will be written on the share certificate. Now will the share certificate contain names in plural? Yes. If there are joint shareholders we discussed, like for example if there are 3 joint shareholders, then should the company give 3 separate share certificates? No. We said company will give 1 single share certificate which will contain the name of all the 3 people. It will be as if the company has given to each of them. So if there are joint shareholders, all the joint shareholders' name will appear on 1 share certificate. Company will issue 1 share certificate only, not separate for each joint shareholder. Then we discussed that on each share certificate, the company's common seal has to be affixed, but we know common seal is not mandatory anymore. So company, if you don't have a common seal, then in that case, the share certificate will be signed by minimum 2 directors, out of which one of them should be neither managing director nor whole-time director, or it can be signed by 1 director and 1 company secretary. Again guys, on the share certificate, the company's common seal has to be affixed, but if the company doesn't have a common seal, then in that case, on the share certificate, we will put the signature of 2 directors, out of which 1 director is neither managing director nor whole-time director, or we can put signature of 1 director and company secretary of the company. Then details of the share certificate also have to be put in the register of members. We spoke about register of members already in section 43. Remember details about differential shares. If company has issued shares with differential rights, those details also have to be written over here, we learnt. And now one more point we are learning, share certificate details also have to be written over here. Then if the company is having books which contain details about share certificates, those books have to be preserved for at least 30 years. But if dispute is going on, those books will be preserved permanently. Then we discussed, yes, company can print blank forms also. But for that, Companies Act has given 3 precautions. Remember, precaution number 1, a board resolution has to be passed. Only then the blank share certificate forms can be printed. Number 2, the blank forms will be machine numbered so that in between, if any form gets stolen away, we will be able to track better. And lastly, all these blank share certificate forms have to be kept in the custody of company secretary or any other person who is authorized by the board of directors. Then we learned, in case we are surrendering our share certificate to the company, first of all, when will we surrender? Remember, like for example, if the shares are physical shares, but if we want the shares to get converted into demat form, we'll have to surrender the physical share certificate to the company. Now what will the company do with the surrendered physical share certificate? Will the company throw it away? No company, wait. You have to do 2 things, company. 2 Ds. First of all, you have to deface the share certificate. Deface means what? On the face, on the front of the share certificate itself, company has to stamp the word cancelled, and then company you have to destroy it. Destroy immediately. No, wait for 3 years. After 3 years, a board resolution will be passed. Then only the share certificate will be destroyed. That too in the presence of a person who is appointed by the board. Alright guys, so the surrendered share certificates, 2 things. They have to be defaced immediately by stamping the word cancelled on the face of the share certificate, and number 2, they have to be destroyed, but only after 3 years. And then we learned share certificate concept and all will not apply in demat securities, and we also learned that share certificates will have the same amount of significance as currency notes. So if there is any fraud relating to share certificate, it's going to be considered as a severe fraud and it will be punished under section 447. Like remember, we had seen examples where the board of directors are printing fake share certificates to create fake shareholders. All that will get punished under section 447. Then under section 46, we also spoke about duplicate share certificates. In duplicate share certificate, 5 keywords I told you. If the original share certificate is lost or destroyed or defaced or torn or mutilated, in all these cases we can request the company to give us a duplicate share certificate. Tell me the 5 words: lost, destroyed, defaced, torn, mutilated. Again, lost, destroyed, defaced, torn, mutilated. In these 5 cases, we can request the company to give us a duplicate share certificate. But we have to prove that this has happened. How will we prove it, guys? In these 3 cases, we will surrender the original share certificate to the company. We will surrender the torn pieces. We will surrender the mutilated, the defaced original share certificate. We will surrender it to the company. But in these 2 cases, how will the share certificate is lost. How will we prove that the share certificate got destroyed in a fire? We will prove it by filing an FIR. Okay, then we learned for duplicate share certificates, the company can charge a fee, but maximum how much? Maximum 50. And who will decide? The board will decide. Then on the duplicate share certificate, it should be clearly written that it is a duplicate share certificate. And within how much time will the company issue duplicate share certificate, guys? In unlisted companies within 3 months, in listed companies within 45 days. Earlier ICI material wrongly gave 15 days and now it is corrected to 45 days. Alright, so this was a duplicate share certificate discussion. When does the company issue duplicate certificate? If the original is lost, destroyed, defaced, torn, mutilated. All the 5 words have to be written in your answer. Maximum 50 rupees company can charge for the duplicate certificate. On the duplicate certificate, it should be written that this is a duplicate one. And within how much time will the company issue this? If it's an unlisted company, within 3 months, listed companies within 45 days. Then we had renewed share certificate, for which I had shown you one example as well. Renewed share certificate concept comes into the picture when the subdivision or consolidation of shares, merger or demerger or any other reconstitution. All this is okay, we will remember. But what is the most special point of renewed share certificate, guys? Whenever the company issues renewed share certificate, do we have to surrender our original certificate? No. That was a key point over here. In renewed share certificate, surrender of old certificates is not required, because as soon as the company gives us a renewed one, the old one, the original one, automatically becomes a useless piece of paper with which we can just make a rocket and fly it off. Alright, guys. And even for renewed share certificate, the company can charge a fee. How much? Maximum 50 rupees. Then we discussed company will keep a separate register, a register of duplicate and renewed share certificates, where either at the registered office or wherever the register of members is kept in form number SH2. This register has to be preserved permanently in the custody of company secretary or any other person authorized by board of directors. So this was section 46, guys, a big section about share certificate, just highlighting some important points over here. Point number 1, the first important point, in the share certificate, will the company write the name of all the joint shareholders? Yes. Will the company give a separate share certificate to each joint shareholder? No. Then we had learned that can the company print blank share certificate forms? Yes. How many precautions has Companies Act given in that regard? 3 precautions. Precaution number 1, board resolution has to be passed. Only then blank share certificate forms can be printed. Each blank form has to be machine numbered and it has to be kept in the custody of company secretary or any other person appointed by the board. Then remember, books containing details about share certificates have to be preserved for 30 years. If dispute is going on, they have to be preserved forever. And then we had learned duplicate and renewed share certificate. Just tell me the key words, guys. Duplicate share certificate, tell me the key words. When will the company issue duplicate share certificate? If original is lost, destroyed, defaced, torn or mutilated. And when will the company issue renewed share certificate? If there is subdivision of shares, consolidation of shares, merger, demerger or any other reconstitution. Okay, and also remember, in renewed share certificate, we don't have to surrender the original share certificate. Alright, come on everybody, let's go ahead. Let's go to section 56 now, which talks about transfer and transmission, a very simple yet a very important section. First, let's talk about transfer and then we'll go to transmission. See, transfer is nothing but a voluntary conveyance of rights and duties of a member by a shareholder who wishes to cease to be a member to a person who is desirous of becoming a member. First of all, it is voluntary, which means if I'm transferring the securities to you, it's because I want to sell the shares to you and you want to buy it from me. So it's not automatic, it's not that law is doing this movement, it happens voluntarily. It's a voluntary conveyance of rights and duties of a member, which means till yesterday I was the owner of the shares, I was enjoying the rights and I was fulfilling the duties of a member. But I don't want to continue as a member anymore and you want to become a member. So I'll transfer my shares to you. Now you will enjoy the rights and you will fulfill the duties of a member. So tell me the definition again. Transfer is nothing but voluntary conveyance of rights and duties of a member by a shareholder who wishes to cease to be a member to a person who is desirous of becoming a member. Now can shares be transferred? Yes, they are movable, they can be transferred. The right to transfer is an absolute right, it's an inherent right. AOA cannot take away this right from us. If it's a public company, shares are freely transferable. In a private company, also shares are transferable, only that there is a restriction. And what is the restriction? If I am a shareholder of a private company and if I want to transfer the shares, I have to first offer the shares to the existing shareholders. Only if none of the existing shareholders are willing to buy the shares, only then I can transfer the shares to the outsiders. Then after this, we had learnt that whenever the company, if I am a shareholder of the company and if I want to transfer the shares, what's the procedure? The transferor or transferee one of us will submit 2 documents to the company. Repeat again, transferor or transferee, one of us will submit 2 documents to the company. Number 1, instrument of transfer in form number SH4, and number 2, the share certificate containing the transferor's name. So this SH4, this instrument of transfer, has to be stamped, which means stamp duty has to be paid. It has to be signed by both transferor and transferee, and it has to contain all the details about the transferee, like his name, address and occupation. A very important point in SH4 is that it has to be submitted by whom? Transferor or transferee. But it has to be signed by whom? Transferor and transferee. And another important point about SH4 is that it has a validity period of 60 days, which means we will see when was this SH4 executed. From the date of execution, within 60 days itself, it has to be submitted to the company. We had learnt about the logic also behind the 60 days. We had discussed that if we don't have the 60 days criteria, then people will not even write the transferee's name. They'll keep making blank transfers one after the other, and because of these blank transfers, company will lose stamp duty and company will also lose capital gains income tax. So that is why within 60 days itself it has to be submitted to the company. Guys, something similar we had in prospectus chapter also. Remember, in prospectus chapter we had learned that once we file the prospectus with the ROC, within 90 days it has to be issued to the public. So same way, even SH4, once it is executed, from the date of execution, within 60 days itself it has to be submitted to the company. Okay, so 60 days is a maximum time limit, not minimum time limit. Alright, then so therefore what is transfer? Transfer is nothing but voluntary conveyance of rights and duties of a member by a shareholder who wishes to be a member to a person who is desirous of becoming a member. To transfer the securities, what is the process? The transferor or transferee, one of us will submit 2 documents to the company. Number 1, SH4, instrument of transfer, and number 2, share certificate. The SH4, the instrument of transfer, has to be stamped. It has to be in this particular form only. It will contain the transferee's name, address, occupation. It has to be signed by both. From the date of execution, within 60 days itself, it has to be submitted to the company. Then we learnt about transmission. Wait, before transmission we had also spoken about one equation. I told you if the SH4 is submitted by the transferor and if the shares are partly paid up shares, then SH5 process will apply. You remember this equation, guys? I'll repeat again. If the documents, we just learned, right, that the documents will be submitted by transferor or transferee. So if the documents are submitted by transferor and the shares are partly paid up shares, then the company will become a little alert. Company will inform the transferee. Company will send a notice to the transferee, inform SH5, informing the transferee, do you know these are partly paid shares? So therefore, later whenever I make a share call, you only will have the liability to pay the amount which is due on the shares. The transferee has to send no objection within 2 weeks, only then company will go ahead and register the transfer. But try to recall, will SH5 process apply every time the shares are partly paid up? No. SH5 process will apply only if the SH4 was submitted by transferor. Only then, if the shares are partly paid up shares, company will send SH5 notice to the transferee informing him that the shares are partly paid up shares, asking him for no objection certificate within 2 weeks. Then we learned about transmission. Transmission, we said this is not voluntary. Transmission happens by operation of law. Transmission happens automatically in some cases, whether you like it or not, automatically it will happen. Like when the shareholder dies, automatically the shares will go to his legal representative. When the shareholder becomes insolvent, automatically the shares will go to the official receiver. When the shareholder becomes lunatic, automatically the shares will go to the administrator. But in transmission, there is no concept of instrument of transfer. Instead, we have intimation of transmission. And remember, for instrument of transfer we have a form, but for intimation of transmission we don't have any form. So which means we will simply take one A4 size paper, write about transmission and submit it to the company. There is no form over here, no stamping requirement is there over here, no 60 days criteria. All this is not applicable in transmission. So in transmission the movement is happening from one person to another person, not voluntarily. It is happening automatically by the operation of law. Here the document is called intimation of transmission. There is no prescribed form for this, no stamping is required, and 60 days criteria is also not applicable over here. Then over here in relation to transmission, you remember 2 stories I gave you, and I told you that both the stories are right. In the first story, like for example, let's say the shareholder died. So the legal representative informed the company about the transmission, got his name entered into the register of members, became the member of the company, and only then transferred subsequently to another person. In the second story, if you remember, transfer, the legal representative did not even inform the company about the transmission. He did not even become a member of the company. Without becoming the member of the company, he directly transferred the shares to another person. We said both are right. We said legal representative, even though you did not get your name entered in the register of members, as if the legal representative is a holder of shares, he can transfer. Even though he has not become the member of the company, even though in the register of members his name is not written, in the register of members, still he can transfer shares to whomever he wants. It will be as if the owner of the shares has transferred. Okay, so this was transmission. Doesn't happen voluntarily, happens automatically. No instrument of transfer. Instead, we have intimation of transmission over here. No stamping requirement. 60 days requirement is also not there. Then we spoke about the time limit within which the share certificate has to be issued. We discussed that at the time of incorporation, we prepared the MOA, guys. In the MOA, we have the subscription clause, guys, and the persons who sign the subscription clause, they are called as subscribers, and each subscriber has to take minimum 1 share in the company. So these subscribers have to be sent a share certificate within 2 months from the date of incorporation. In allotment cases also, time limit is 2 months from the date of allotment. In transfer transmission cases, the time limit is 1 month. 1 month from the date on which the company receives the instrument of transfer, 1 month within which the company receives the intimation of transmission. And for debentures, we have 6 months time. Okay, then comes section 57, personation of shareholder. Very simple section. Section 57 says there's a person. He is actually not owning any shares, but he is personating to be the owner, which means he is pretending to be the owner so that he can enjoy the securities, he can enjoy share warrants, or he can enjoy any money which is actually due to the shareholders. So in such cases, we will say that he is personating and he will be punished under section 57. Important punishment we discussed. Imprisonment minimum 1 year, maximum 3 years, and how much fine? Fine minimum 1 lakh, maximum 5 lakhs. This is personation of shareholder. Then we discussed that there is a concept called as forged transfer also. Now, forged transfer, I'll straight away come to this diagram, guys. We have this shareholder, Mr. Green. So, in the company's register of members, whose name is written? Green's name is written. Okay. Now, Green, he's owning shares of the company. Purple comes to Green and asks Green to transfer the shares to him. But Green says, I have no interest in transferring the shares right now. So, what does Purple do? Purple does 2 things, guys. Number 1, Purple steals the share certificate containing Green's name. And number 2, Purple takes SH4. In SH4, he puts all his details as if Green is transferring to Purple, but just now we learnt in game SH4 has to be signed by whom? Transferor and transferee. So he puts his own signature, but now Green's signature is also required, but Green is not willing to sell away the shares. So Purple puts Green's signature, which means Purple forges Green's signature. So SH4 becomes a forged document, and both of this he submits to the company. Company doesn't know that there is forgery over here. On the basis of these 2 documents, company registers the transfer, which means company removes Green's name from the register. Company puts Purple's name in the register. Company gives to Purple a new share certificate containing whose name? Containing Purple's name. And Purple becomes a member of the company. And Green has no idea that all this has happened. Then enters into a story another person, Mr. Red, who is a genuine buyer, which means he has no idea that all this has happened. He looks at this share certificate. He relies upon this share certificate. Come on, guys, a share certificate is issued by the company saying Purple is the owner of the shares. So, of course, Red can rely upon the share certificate. He trusts this share certificate. He believes that Purple is a member of the company, and he buys the shares from Purple, gives consideration for the shares, again submits all the documents to the company. Company removes Purple's name. Company puts Red's name in the register, and company gives to Red a new share certificate containing Red's name. Now, after all these days, Green wakes up and Green wonders that why has the company not given him dividend for all these days? Why is the company not sending him notices all these days? So Green comes to the company and tells company, what did you forget? I am your shareholder. Where is my dividend? Where are my notices? Company says, what, Mr. Green? You sold the shares to Purple. Purple sold to Red. Red only is the owner. You are not the owner anymore. That is when Green realizes everything that has happened. Green comes to the company. Green proves to the company on SH4 that signature is not my signature. That signature is forged. Green proves forged transfer. Once the forgery is proved, remember, forgery is a nullity. Forgery is going to be void, which means once Green proves that his signature is forged, it is as if his signature is not even there. Guys, if on SH4 transferor's signature is not there, that SH4 will become invalid. If SH4 is invalid, green to purple, transfer will become invalid. If transfer is invalid, purple will not have any rights in the shares. If purple doesn't have any rights in the shares, he can't give any rights to red. So green only is the owner of the shares. Green will have the right to get his name back into the register. Okay, so once green's name comes back in the register, also in this entire period, whatever dividend he has lost, also all the dividend company will give to green. But now who will be sad, guys? Red will be upset. Red will think, company, you only gave a share certificate saying purple is the owner. I relied upon that share certificate which you gave. I bought shares from purple. I gave him consideration, and now you are saying I am not a member of the company. You are saying green only is a member. What nonsense. So company will have no choice. Company will have to compensate red because red has suffered a loss because he relied upon the share certificate issued by the company only. So company will have to compensate red. Now who is upset? Now company is upset. Company is wondering, what is my fault? Why did I have to give compensation to red? Because of giving compensation to red, I have suffered a loss, and everything is because of whom? Because of this Mr. Purple. So whatever loss the company has incurred, company will ask for indemnity. Indemnity means what? Reimbursement. Company will ask for reimbursement, compensation from purple. Alright, and also purple, he is the one who has tried to be a shareholder. He has tried to pretend to be a shareholder. He will be punished under section 57. Personation punishment also will apply over here on purple. And the transfer between green to purple is called as forged transfer. Why? Because this transfer happened on the basis of a forged signature. So this was our entire discussion on forged transfer, guys. Remember, forgery is a nullity. And by the way, can red take protection under doctrine of indoor management? Doctrine of indoor management says, outsider, you can assume all internal rules are fulfilled. So can red take protection under doctrine of indoor management? No. When we learned about doctrine of indoor management, we had learned that forgery is an exception. When there is forgery, it will result in nullity. It will be void. No doctrine can protect you. It's a universal principle across every law, across every country, that forgery is equal to nullity. Alright, so this was our discussion regarding forged transfer. Then we learnt about section 58, where we learnt about refusal to register the transfer. I'll straight away come to the diagram. I told you that once we submit all the documents to the company for transfer or transmission, as the case may be, same concept only will apply for both. Once we submit the documents to the company like SH4, intimation of transmission, share certificate, once we submit all this to the company for registering the transfer or the transmission, there are two possibilities. Either company will accept the documents and the company will register the transfer or transmission, or the company will refuse to register, guys. If company accepts the transfer or transmission, company will send new share certificate. Remember, we learned in transfer transmission cases, company will send new share certificate within 1 month. So if once we submit all the documents to the company, if the company accepts the document, if the company is willing to register the transfer, company will send new share certificate to the transferee within 1 month. But if the company refuses to register the transfer, company has to send refusal notice to whom? To both transferor and transferee. Within how much time? Within 30 days. So if you notice, it's more or less going to be the same only. In if the company wants to accept the transfer or transmission, company will send new share certificate to the transferee within 1 month. Within 1 month. But if the company wants to refuse to register the transfer, company will send refusal notice to transferor and transferee within 30 days. So the time limit is 1 month for share certificate, 30 days is for refusal notice. Now once a company sends refusal notice, once a transferee receives the refusal notice, the transferee can file an appeal before NCLT within 30 days in private companies, within 60 days in public companies. You remember this whole thing, guys? Yes, so the whole time limit is pretty simple. Listen to me everybody. What are we discussing about right now? We are discussing about the time limits relating to refusal to register the transfer. So point number 1, if the company registers the transfer, once we submit the documents, there are only two possibilities. Either company registers the transfer or the company refuses to register the transfer. If the company registers the transfer, company will send a new share certificate, SH1, a new share certificate in whose name? In the transferee's name. To whom? To the transferee. Within how much time? Within 1 month. Within 1 month from the date on which the company received the documents. Then if the company wants to refuse to register the transfer, company will have to send refusal notice. But refusal notice company will send to whom? To both, to transferor and to transferee, to both company will send within how much time? Within 30 days from the date on which the company received all the documents. Once the company sends refusal notice, who can appeal? Transferor can't appeal. Only the transferee can appeal because he only is the aggrieved party, and the transferee has to appeal within the next 30 days before the NCLT. Okay, if it's a public company, 30 days will be read as 60 days. Okay, but what if we waited, company neither registered the transfer nor sent refusal notice? Then in that case, it will be deemed refusal. We will assume as if the company has refused and the transferee can file appeal. Within how much time, guys? We had learned 30 plus 30, within 60 days the transferee can file appeal. But if it's a public company, 30 plus 60, within 90 days the transferee can file appeal. Understanding? If the company neither registers a transfer nor sends refusal notice, then we will assume the company has refused. It is deemed refusal. In deemed refusal cases, the transferee can file appeal before NCLT. Within how much time? See, I had given you the logic behind this as well. Within how much time transferee will file appeal before the NCLT? See, we had discussed that if the company had actually sent refusal notice, company would have sent within 30 days, and within next 30 days transferee could have filed appeal. So transferee would have had 60 days time. So within those 60 days, the transferee has to file appeal before NCLT if it is deemed refusal. But if it is a public company, then how would the time limit would have been? Company would have sent refusal notice within 30 days. Transferee would have filed appeal within 60 days. So within 30 plus 60, within 90 days in deemed refusal cases, in public companies, appeal can be filed before NCLT. But do not forget, refusal notice company will send to both. But appeal can be filed only by the transferee. Within 30 days in private companies, within 60 days in public companies. But if company is neither sending share certificate nor sending refusal notice, we will assume refusal, and in that case appeal has to be filed within 60 days in private companies, within 90 days in public companies. In deemed refusal cases, the time limit will start when? The time limit will start on the date on which all the documents were delivered to the company. Okay, then once we file an appeal before NCLT, what will NCLT do? Either NCLT will dismiss the appeal, or NCLT will ask the company to go ahead and register the transfer or transmission within 10 days, or NCLT will order rectification of register. Then we had discussed that when will NCLT order rectification of register? Only in 3 cases. Either I am not a member of the company, but unnecessarily company has put my name in the register. Or if I am a member of the company, but why is my name not in the register of members? Or we have submitted all the documents to the company for transfer or transmission. Now company is supposed to remove in the register of members the transferor's name and put the transferee's name. Unnecessary delay the company is doing in this changing of name in the register. So in these 3 cases, we can ask the company to rectify the register. And remember guys, who can ask for rectification of the register? Not just that person who is suffering. Any member can go to the NCLT and ask for rectification of register. Not just the member who is suffering because of the wrong register. Any member can go and ask for rectification because every member has interest in ensuring that the register is properly maintained. Alright, then we had started learning about kinds of share capital. So transfer, transmission, refusal to register the transfer, transmission, NCLT's order, then rectification of register. All this is clear. Rectification of register only in 3 cases. Who can ask for rectification? Not just the person who is affected because of the wrong register. Any member can ask for rectification of register because every member has interest in ensuring that the register is properly maintained. Okay. Now coming to the different kinds of capital, we learned that nominal capital, also called as authorized capital, is a maximum amount of capital which the company can have. Its stamp duty and all is paid on the basis of this nominal capital only at the time of incorporation. Issued capital is out of the nominal capital, how many shares company has issued for subscription. Out of issued capital, how many shares have been subscribed for is subscribed capital. This is the main amount of capital we discussed. This is the amount which the company has a right to receive in the name of capital. Then this much money company has a right to receive, but out of that how much has the company demanded, that is called as called up capital, and out of that how much has been paid by the shareholders, that is paid up capital. So called up capital minus calls in arrears will give us paid up capital. Now coming to our next discussion, which is section 61. Section 61 talks about alteration of share capital. Before we revise about this section, let me give you the background information which I had given you even earlier. See, we write in our MOA. In our MOA, we have starting again. Okay, so starting with another section now, section 61, which talks about alteration of share capital. Before we dive into the section, let me give you some basic points. See, we have the memorandum of association. In the memorandum of association, we have several clauses. One of the clauses is the capital clause, guys. Now, in the capital clause, we write the authorized capital of the company, but we don't straight away write the amount. We write the breakup, right? Like for example, we write 1 lakh shares of 10 rupees each, total 10 lakhs. Like this, we will give the breakup of authorized capital in the capital clause, right, guys? Now, in this MOA, name clause, situation clause, objects clause, anything else if you want to alter. We learned section 13 in MOA AOA chapter, right, guys? So if you want to alter any clause of MOA, we pass SR. But if alteration of capital clause, we did not learn in the MOA AOA chapter, because alteration of capital clause is covered in section 61. If you want to alter either the authorized capital or if you want to alter this breakup, welcome to section 61. Okay, so first of all, you know what you're learning about? You're learning about alteration of the capital clause in the MOA. In the MOA capital clause, we write the authorized capital. We don't write issued capital, paid up capital and all over here. Only authorized capital we write. So if you're doing a change because of which either the breakup is going to change or the amount is going to change, for that change, we have to follow section 61. Any other change you want to do in MOA, SR is required to be passed. But capital clause, this if you want to change, only an OR, ordinary resolution only is required. With this basic understanding, now let's dive into section 61. There are totally 5 situations only when section 61 will apply. In all these 5 situations, if you see, the point will be common. Either this number will be changing or this breakup will be changing. The first situation, we want to increase the authorized capital, increase or decrease the authorized capital. This number will change, breakup also will change, fully it will change. Number 2, we want to consolidate shares. We want to subdivide shares. When we want to consolidate shares, what are we doing in consolidation? We are grouping shares together. Like earlier, 1 lakh shares of 10 rupees each. Now we are consolidating shares together. Now let's say we are having 10,000 shares of 100 rupees each. So we are grouping shares together. We are consolidating shares together. That is consolidation of shares. In consolidation of shares, the total amount doesn't change. Only this breakup changes. Earlier it is 1 lakh shares of 10 rupees each. Now it will become 10,000 shares of 100 rupees each. Example. In subdivision of shares, what do? We break the shares into smaller parts. Subdivision of shares also called as stock split. Consolidation of shares also called as reverse stock split. Remember, in subdivision of shares, I am breaking my shares into smaller part. Like earlier, 1 lakh shares of 10 rupees each. Now I am breaking it into smaller parts. I am saying that this will now be 10 lakh shares of 1 rupee each. So even in subdivision, even in consolidation, in both of these, the total capital number doesn't change. Only the breakup changes. In consolidation, the number of shares will reduce. We will group the shares together. In subdivision, the number of shares will increase. We will break the shares into smaller parts. Okay. Then this is nothing but converting fully paid shares into stock. We learnt even in the initial part of the chapter, converting fully paid up shares into stock or vice versa. And this is the most important, guys. Here we are cancelling shares which have not been taken up by any person. That is, we are cancelling unsubscribed capital. What are we cancelling? Tell me. We're cancelling unsubscribed capital. We're cancelling this unsubscribed capital from where? From 2 places. From issued capital also, from authorized capital also. From both the places we are removing unsubscribed capital. That will also come under section 61, last box. We're cancelling unsubscribed share capital. We're cancelling the shares which have not been taken up by any person. Where are we cancelling this from? From authorized capital also, from issued capital also. So the authorized capital number will change. We are reducing the issued capital also, but section 66, reduction of capital, will not apply. Section 61 only will apply. So this is your alteration of capital, guys. 5 situations. In all these 5 situations, either your total number will change or the breakup will change. Only an ordinary resolution is required. Okay. In all these 5, only the authorized capital number only is going through a change. Paid up capital, subscribed capital, called up capital, issued capital, and all is not changing. Only in the last box, issued capital is also changing. But still section 66 will not apply. Section 61 only will apply. Okay. Now coming to our next discussion, section 62, rights issue. Simple point, guys, very simple point. Whenever the company wants to raise more money by issuing more shares, company has multiple options. But company should first go to existing shareholders only and offer them rights shares. Only if the existing shareholders don't agree to give more money to the company, only then company will make a private placement or make a public offer or go to the employees and all. But if the company wants to raise more money by issuing equity shares, company should first go to existing shareholders only. This is called as a preemptive right of the existing shareholders. Now when the company is offering shares to the existing shareholders, it will always be on a proportionate basis. So company will first of all have to send the offer to the existing shareholders. The document is called as letter of offer. In the letter of offer, company will mention that how many shares are we going to offer and what's the time period within which the offer should be accepted. The time period we learned, it should not be less than 15 days, it should not be more than 30 days, but as per rules, it should not be less than 7 days. If you remember, Godavari's letter of offer with all the time limits I showed you, it should not be less than 15 days, should not be more than 30 days. As per rules, it should not be less than 7 days. Now in this calculation, what about Sunday? What about holidays? I showed you, even if Sunday is included, you will count Sunday also. Even Sunday is included. We are not saying 7 working days, we are saying 7 days. Okay, so in rights issue, companies offering shares to existing shareholders for free? Definitely not. The shareholders have to pay a price. Company is making rights issue because company wants to raise funds. It is not for free. For free will be called as bonus shares. Section 63, next section. In section 62, company is raising funds. So rights issue is also for a price. It's called rights price. Generally, the rights price is below the market price. The company is offering shares to the existing shareholders for a price called rights price proportionate to the number of shares that they are already holding. So company will send to the existing shareholders a document called letter of offer containing all the details about the rights issue. Now in the letter of offer, it will be mentioned that shareholders have 3 rights. They have 3 options. Either they can accept the right and they can subscribe to the shares, or they can reject the right. They can say, company, we are already fed up since the time we bought your shares, we don't want more shares. They can reject the right, or they can also renounce the right. Remember renunciation. They can renounce the right to another person. Whether that other person is a member of the company or not doesn't matter. Okay, and then we also learned the letter of offer. When should it be sent to the shareholders? We will see what is the date of opening the issue. Before that, leave 3 days. Before 3 days itself, company should send the letter of offer to all the existing shareholders, either by registered post or by speed post or by email or by any other mode having proof of delivery when at least 3 days before opening the issue. Okay, then after this we had discussed that the 3 options I told you, reject, accept, reject or renounce. The person to whom you are renouncing, that person can be any person, shareholder or not a shareholder, doesn't matter. Now what if the shareholder is neither accepting nor rejecting nor renouncing? What if he doesn't do anything within the time period? Time period is over. Now what will happen? We will assume that he has rejected the shares. Now what will happen with the rejected shares? The rejected shares can be disposed by the board of directors. Board of directors may dispose them in the manner which is most advantageous to the company. In the manner which is most advantageous to the company, the board can dispose the shares. When the board is disposing the shares, does the board again need shareholders' permission? No. Shareholders, you only know rejected the shares. Those shares only we are disposing. We will not again ask you permission before disposing. Then we discussed about this very important point, is renunciation right automatic? Guys, in AOA, nothing is written. In the letter of offer, nothing is written about renunciation. Do I have renunciation or not? By default, you will have renunciation. Only if AOA is silent, only if in AOA it is mentioned, only then no renunciation. By default, we will all have renunciation right. And then we learned whatever time limits we saw over here, 15 days, 30 days, 3 days, all of these are not applicable to private companies. But which private companies? Those private companies in which they get permission from at least 90% of the members, written permission either in writing or by mail. They need permission from 90% of members at least, then these time limits they can change. So this was about rights issue. So giving you one quick recap. Once again, listen to me. I'm giving you a revision of the revision. Listen to me again. So we're talking about section 62. In section 62, company wants to raise more money by issuing more shares. So company, whenever you're issuing more shares to raise more money, you first offer shares to existing shareholders. This is a preemptive right of the existing shareholders. Only if the existing shareholders are not willing to give more money to you, only then you go and offer the shares to the outsiders, like public offer, private placement and all. You do only if existing shareholders are not giving you the money that you need. So when the company is offering shares to the existing shareholders for a price which is called as rights price, which is generally lesser than the market price, proportionate to the number of shares which the shareholders are already holding, the company will send them this offer through a document called as letter of offer. Now the letter of offer will contain all the details like what price, how much do the shareholders have to pay for the shares, then how many shares can they subscribe for. All this information will be put in the letter of offer itself. Letter of offer will also contain the issue opening date and the issue closing date. This time gap can be minimum 15 days, maximum 30 days. The time limit also will be written in the letter of offer only. As per the rules, it should not be less than 7 days. Then we learned the date of opening the issue. Before that, leave 3 days. Before 3 days itself, the company should send the letter of offer to all the members by registered post, speed post, email or any other mode having proof of delivery. Then we learned shareholders, just because the company is giving you rights issue doesn't mean you have to buy the shares. It's not an obligation, it's an option. How many options? 3 options. Shareholder, either you can accept the right and buy the company's shares and give the company money, or you can reject the right, or you can renounce it to another person. You can renounce it means when you're renouncing, are you selling the shares to another person? No, you're only selling the right to buy rights share to another person. In capital, I'm getting reminded of capital gains. Capital gains also we had done questions from here. Anyways, coming back. Then we discussed, what if the shareholder is neither accepting nor rejecting nor renouncing? We'll assume that he has rejected. And if he has rejected, what will we do with the rejected shares? Who will decide what to do? The board will decide. Board will dispose them in a manner which is most advantageous to the company and shareholders. Then we discussed, if the letter of offer is silent about renunciation, then by default shareholders, you do have renunciation right. If renunciation right is not available for you, it will be mentioned in the AOA. Only then not available for you. And lastly, we discussed that all the time limits that we saw over here, none of these time limits will apply to private companies provided they get written consent or email consent from how many members? At least 90% of the members. Story over. This is it about rights issue. But section 62 is not over. One whole class we spent on section 62. So in section 62, the main point is rights issue. But rights issue is not the only way in which company will raise money by issuing further shares. Rights issue is one of the methods. But if the existing members are not willing to give more money to the company, then we have other options, guys. We can give ESOPs to employees. Remember, ESOPs, employee stock option plans. Here we are giving an option, not obligation. We are giving an option to the employee. Today we are giving an option telling the employees that employees, if you want in the future, you can buy the company's shares. So here, if you remember, we had multiple terminologies. We will see what is the date of grant of option. But immediately the employees cannot exercise the option. There will be a time gap. That time gap is called as vesting period. So this will be the date of vesting of the option. This vesting period will be minimum 1 year. It can be more than 1 year also, minimum 1 year. Don't get confused now. In sweat equity shares, section 54, there we had lock-in period. Lock-in period was equal to 3 years. We did not say at least 3 years. We said equal to 3 years. Lock-in period is 3 years. But now in ESOPs, here no lock-in period, guys. Here we have vesting period. Vesting period has to be minimum 1 year. Can be more than 1 year also. In ESOPs, then what is the lock-in period? Lock-in period, exercise period and all this Companies Act is silent. All these things we're telling the company, you decide. Now what is this exercise period? What is this vesting period? Listen, come back to this now. We will see when did the company give you the ESOPs. That is the date of granting the options. But when can you start exercising? There will be a time gap. This time gap is called as vesting period. Once a vesting period is over, the ESOPs will vest in you. ESOPs will vest in you means this is the date when you will have the right to exercise the option. But there will be an exercise period. It's not necessary that on this date itself, exactly on this date itself, you have to exercise. Like that, no. You will have an exercise period. Once a vesting period is over, then the options will vest in you. Once the options vest in you, you have the right to exercise the option now. So there will be an exercise period. In this exercise period, on any day you can exercise the option. Exercise the option means you will pay money and you will get shares. Now how much you will pay? What is the exercise price? It's a predetermined price, which means on this date when the company is granting the option to you, that time itself company will tell you that in the future whenever you exercise on that day how much you have to pay. Today itself we will tell you. That is why it is called as predetermined price. Now you employee, you have to continue to work for me till you exercise. Only then you can exercise. If you leave in between, if you are fired in between or if you resign in between, then the options will also lapse along with you. Understanding everybody? So in ESOPs, company is giving ESOPs to directors, officers or employees of company, holding company or subsidiary company. Here lock-in period, the law doesn't say anything. The exercise period, the law doesn't say anything. So lock-in period and exercise period, company you decide. But vesting period, the law says minimum 1 year. Law doesn't say equal to 1 year. Law says it will be minimum 1 year, which means company you decide what should the exercise period be. And what should the vesting period be. And this terminology you understood, this is the date on which the company is giving the option to you. But immediately and all you can't exercise. You have to continue to work for 1 period, then only you will become eligible to exercise. When you become eligible to exercise, that is called as state of vesting of option. Once you become eligible to exercise, not necessarily on that day itself you have to exercise. No, you will get one exercise period. In this period, any time you can go and exercise. When you exercise, you will not get the shares for free. You have to pay exercise price. But how much price I have to pay? How will I know? When the ESOPs are granted to you, that day itself the exercise price will also be decided. That is why it is called as predetermined price. Understood all the points, guys? Now, if the company is issuing ESOPs to employees, before this we have to get special resolution from the shareholders, because without giving shares to shareholders, we are going to employees and we are giving ESOPs. So we have to get consent from our existing shareholders in the form of special resolution. Then we learned ESOPs cannot be given to independent directors because independent directors are independent, which means they are not having any connection with the company. But if we give them ESOPs, later they will become shareholders. So later a connection will get created between us and independent directors. So they will not be independent anymore. So we can't give ESOPs to independent directors. We also can't give ESOPs to promoters. We also can't give ESOPs to those directors who are already holding more than 10% shares. They are already holding more than 10% shares. If you give them ESOPs also, they will start having major control over the company, and that we don't want. Then we discussed, right now I am having only ESOPs in my hand. I didn't exercise till now. I am only having ESOPs in my hand. These ESOPs I can't transfer. On these ESOPs I will not get voting right, dividend right and all. I am not shareholder of the company till now. Once I exercise the option and get the shares, now I have shares in my hands. Now I become a member of the company. Now I'll get voting right, dividend right and all, and I will get. I have to keep the shares with me during the lock-in period. After the lock-in period I can transfer. And then we discussed, during the vesting period, if the employee dies, then the ESOPs will go to his legal representative. During the vesting period, if the employee suffers from a permanent incapacity, like if he goes into coma or if he gets paralyzed, then on that day itself the ESOPs will vest in him. But if he resigns or if the company fires him, then the ESOPs will lapse. And if it's a listed company, SEBI regulation also has to be followed, and to issue ESOPs, I just told you special resolution is required. But if it's a private company, an ordinary resolution will be enough. So this was our discussion on ESOPs, right guys? So all the terminology is also clear and the time limits are also clear. Remember, vesting period is minimum 1 year. Then, so under section 62, there are totally 4 things. One is we are offering shares to our existing shareholders, rights issue. Second is ESOPs to employees. In the third issue, the third is nothing but your entire prospectus chapter, guys. The company is offering shares to outsiders. That is, either company is making a public offer or company is making a private placement. Even over here, company has to get a prior special resolution passed. Then when the company issues convertible debentures or convertible preference shares, see today, okay, not a problem. But in the future, when the debentures are converted into equity shares, there will be more number of equity shareholders in the company. So existing equity shareholders, their control over the company will become lesser. So today when we are issuing the convertible debentures, that time itself we need to get special resolution from the shareholders. See, don't make a mistake. When is SR required? Is SR required at the time of issue of convertible debentures, or is SR required at the time of conversion? Not at the time of conversion, guys. Only at the time of issue of the convertible debentures. Then we came to the fourth part, the fourth limb, the most important limb of section 62, wherein the government on one side. This government can be central government or the government can be state government. We have government on one side and on the other side we have company. Company owes money to the government. Now company is unable to repay that money. That money which the company owes to the government, originally it is not convertible and all. Company just owes money to the government. Okay. Now government is thinking it is required in the best interest of the public to convert the loan which company owes to the government into shares. In reality, originally it is not a convertible loan. There is no convertible point in the terms and conditions and all. But company is unable to repay. So government will put unnecessary pressure on this company to repay. So instead of doing that, government is thinking it is better in public interest if that loan gets converted into equity. So in such cases, government will pass an order converting the loan into equity. What are the terms and conditions? It will be converted into how many shares? All the terms and conditions the government will tell to the company. See, can the company appeal against the conversion? No. The company can appeal only against the terms and conditions of the conversion. If the company is not okay with this conversion, the company cannot appeal against the conversion. Company cannot say no, don't convert like that. Like that company cannot say. But if company is not okay with the terms and conditions of conversion, that company can appeal. Within how much time? Within 60 days. Within 60 days of the government's order. Then if the loan is converted into equity shares, total number of equity shares in the company will increase. To that extent, authorized capital is deemed to be increased. Section 61 OR and all doesn't have to be passed. The authorized capital is deemed to be increased. Alright. So this is section 62 subsection 4. In this particular point alone, I want you to remember the subsection number also. It's simple to remember, guys. It's the fourth limb of section 62 subsection 4. Okay guys, so total 4 things we have in section 62. In the first limb, the company is raising more money by issuing more shares to existing shareholders. In the second limb, company is raising money from the employees by giving ESOPs to them. In the third limb, company is offering shares to outsiders in the form of public offer or in the form of private placement. In the fourth method, company has a loan which the company owes to the government. Company is unable to repay. So instead of putting pressure on the company to repay, the government is telling the company in public interest to convert those loans into shares, even though originally that was not a convertible loan. Okay, so going to the next section now, which is section 63, which talks about bonus issue. Even in bonus issue, like rights issue, the company is offering more shares to whom? To the existing equity shareholders of the company. But the difference is, in rights issue, in return the company is getting the rights price. But bonus issue is made for free, which means we are not charging anything from the shareholders. So in bonus issue also, the company is offering more shares to the existing shareholders of the company on a proportionate basis. So because the company is issuing more shares, we will credit share capital. But what will we debit? We can't debit money, we can't debit cash or bank because no money is coming in. So what will we debit? We will debit our reserves like free reserves, securities premium or CRR. Any of these we can debit, but we can't debit revaluation reserve. Then we discussed that whenever the company wants to make a bonus issue, like dividend, it is recommended by the board and it is authorized by the shareholders in the meeting by passing an ordinary resolution. Then company can make a bonus issue only if it is authorized by the AOA. There should not be any subsisting default with respect to repayment of deposits or debentures. There should not be any subsisting default relating to statutory dues of employees. The outstanding partly paid up shares should be fully paid up. Only then the company can issue more bonus shares. We learnt logic also for this. What's the point? The point is, if the company is issuing bonus shares, the existing shares should be fully paid up. Only then the company can issue bonus shares. And lastly, if the company has declared dividend, company should pay dividend. If company has declared bonus shares, company should issue bonus shares. Company can't declare dividend and give bonus shares instead. Company can't declare bonus shares and give dividend instead. Bonus shares and dividend, yes, both are distributions for shareholders, but there's a difference. In dividend, money is coming in for the shareholders. In bonus shares, more shares are only flowing in for the shareholders. So bonus shares cannot be issued in lieu of dividend. So this was section 63, guys. Simple section. Company is offering more shares to existing shareholders proportionate to the shares which they are already holding in the company. So share capital will be credited. What will we debit? Free reserves, securities premium or CRR. In fact, we learned CRR can't be used for any other purpose except to issue bonus shares. Revaluation reserves and all we can't debit. Then we learned that bonus share is nothing but capitalization of profits, because we are simply taking money from the reserves account and putting money into the share capital account. So we are simply capitalizing the reserves. This was also held in the case of Standard Chartered Bank versus Custodian. And then we saw the conditions. It has to be authorized by AOA. It should be recommended by the board and authorized by the shareholders in the general meeting by passing an ordinary resolution. Then there should be no subsisting default relating to repayment of deposits and debentures. There should not be any subsisting default relating to statutory dues of employees. The outstanding partly paid shares should be made fully paid up. And lastly, bonus shares cannot be issued in lieu of dividend. Then we learnt about section 64. Section 64 comes into the picture in three situations. Number 1, whenever the company redeems preference shares. Number 2, alteration of share capital. And number 3, section 62 subsection 4. Remember just now we learnt Government of India, company. Government of India can be central government or state government, and company. Company owes a loan to the government. Company is unable to repay. So in public interest, the government is converting this loan into equity shares and becoming the shareholder of the company. So three situations we're talking about, guys: redemption of preference shares, alteration of capital, and 62 subsection 4. In all these three cases, we have to inform the ROC about it. We have to inform the ROC within 30 days in form number SH7. In all the three, there's going to be a change in the capital clause. See, there's a reason why all the three are combined into section 64, because in all the three, your capital clause is going to change. Like when we redeem preference share capital the number will go down, so authorized capital will change. When we alter the share capital, this we know very well, this in fact section 61 targets authorized capital only, targets capital clause only. In 62 subsection 4, we learned that whenever the loan gets converted into equity shares, in all those cases, it's as if, see, the total number of equity shares in the company will increase upon this conversion. To that extent, authorized capital is deemed to be increased. So in all the three cases, if you see, my authorized capital number is getting attacked. So that is why these three concepts are combined together in section 64. In all the three concepts, we are supposed to inform the ROC after this happens. Within 30 days, we are supposed to inform in form number SH7 along with the altered MOA. Why altered MOA? Because capital clause is going to get changed in all the three sections. So therefore, with the altered MOA with form SH7, ROC has to be informed within 30 days. You understood the logic why all the three we are talking about in one section? Because in all the three, our capital clause, our MOA does get attacked. Okay. So coming to the next concept now, section 66, reduction of share capital. Now this is a concept which you will never forget for the rest of your life, but still let me give you a quick revision once again. See, in section 66, first of all, we had learned the three methods in which we can reduce capital. In the first method, the precondition is that the shares must be partly paid up shares, right? In the first method, the shares must be partly paid up shares, and here what happens is, like for example, let's say 10 rupees share, and let's say 6 rupees is paid up. So what is the liability of the shareholders? Shareholders still have to pay 4 rupees per share, they still have to pay, guys, but the company is telling the members, go members, enjoy, you don't have to pay this 4 rupees per share. So we are reducing or we are extinguishing the liability of the members. This is the first method in section 66, guys. Read the English over here. We are extinguishing or we are reducing the liability of members with respect to capital not paid up. Capital not paid up means what? In our example, 4 rupees is a capital not paid up, that much is still the liability of the members, right? So the company is telling the members, you don't have to pay that 4 rupees per share, you have paid 6 rupees, right? We will reduce the face value also to 6 rupees. So it will be as if 6 rupees share, 6 rupees fully paid up. Shareholders, you don't have any liability anymore. This is the first method. In the first method, the company is extinguishing or reducing the liability of members with respect to capital not paid up. This method will apply only if the shares are partly paid up shares. In the second method, the precondition is that the company is having P&L debit balance, which means the company is having losses. Alright, so here I had given you the balance sheet example. The same example I'll give you again. Let's say in the company's balance sheet, paid up share capital is 1 lakh. So ideally, on the asset side also we should have 1 lakh, but asset side we are having only 80,000. So I asked the company, what happened to the balance 20,000? Company is saying that is my P&L debit balance, which means this is my accumulated loss, which means out of 1 lakh capital, company is right now having only 80,000 left. Balance 20,000 is lost. So now in such case, the real capital of the company is not really 1 lakh, because 20,000 out of that 1 lakh is lost. So company will simply pass the entry share capital account debit to P&L account 20,000. So when the company does this, from the balance sheet, P&L will disappear and paid up share capital will reduce. Paid up share capital will reduce from 1 lakh to 80,000, guys. This is the second method where the company is writing off or cancelling the lost paid up share capital. Lost paid up share capital means what? Paid up share capital which is not represented by assets. In our example, 20,000 was the paid up share capital which was not represented by assets, guys. So company is writing off or cancelling the lost paid up share capital. This is the most common method of reduction of capital. This is what you do in advanced accounts and internal reconstruction also. Then here I had told you, if the company keeps the face value as 10. Let's say earlier face value, before all this face value was 10 and the paid up value also was 10. Now after doing all this, the paid up value is reduced to 8, because for 2 rupees per share, we did not have assets, so we wrote off that paid up share capital. So paid up value has reduced, guys. In the second method, paid up capital is reducing. So paid up value per share, let's say it has reduced to 8. Now if the company lets the face value stay 10 itself, then the liability of members is not extinguished. But if the face value is also reduced to 8, then the liability of members will be extinguished. So if you look at the methods, in the first method, the liability of members will always reduce. In the second method, if you see, the liability of members may be extinguished, it may not be extinguished, it depends. If the company reduces the face value also to the same extent, then the liability will reduce. If the company doesn't reduce the face value to the same extent, then the liability will not reduce. Then in the third method, the company is returning the excess paid up share capital, which is more than the needs of the company. So in the first method, the precondition is that the shares must be partly paid up shares. That's your precondition, that the shares are partly paid up shares. Only then the first method can apply. In the second method, the precondition is companies having P&L debit balance. In the third method, the precondition is that company is having excess money. Company is saying, oh shareholders, you have given me so much money. Money everywhere. What do I do with so much money? Let me return 2 rupees back to you per share. So let's say it was 10 rupees share, and let's say full 10 rupees was paid up. Company saying, I'm going to return 2 rupees back to you. So paid up value will reduce to 8 rupees, guys. Same thing even over here. Now if the company lets the face value stay 10 rupees itself, it means company saying, listen shareholders, right now I'm returning 2 rupees to you, but later whenever need arises, I will ask you to give me the money back. So in that situation, if the face value remains 10, then the liability of members is not reducing. Liability of members is still staying. But if the company reduces the face value also to 8, then the liability of members is extinguished. So in the first method, the liability of members will reduce. But in the second and in the third method, the liability of members may reduce, may not reduce, depends upon is the company reducing the face value also or not. Remember guys? Yes. So first method, extinguishing or reducing the liability of members with respect to capital not paid up. Here the company is having some over here company is having partly paid up shares. Precondition is partly paid up shares. In the second method, company is writing off the lost paid up share capital, which is not represented by assets in the company. So in the second method, company is basically having some P&L debit balance. In the third method, company is paying off paid up share capital, which is in excess of the needs of the company. Company is returning the excess capital back to the members. So in the second and in the third method, the liability of members may reduce, may not reduce. Then we had learnt about the entire process with respect to reduction. First of all, special resolution has to be passed. To pass the special resolution, equity shareholders, preference shareholders, both will get voting right, because we've already spoken about this point in section 47, voting right of shareholders. Then there should not be any subsisting default relating to deposits, and to do this reduction of capital, we also need NCLT's approval. So for this, we had drawn one nice diagram. We said that first of all, the company will submit application to NCLT. Wait, let me show you the diagram itself. Look at this guys, this is the diagram I was discussing with you about. So first of all, SR will be passed. In the SR, equity shareholders, preference shareholders, both will vote. Once the SR is passed, company will file an application with NCLT. NCLT will immediately give a notice of the application to 4 people. Central government, who has delegated this work to regional director, ROC, SEBI. NCLT will give notice to SEBI only if the company is a listed company, and NCLT will also give a notice to the creditors. We had discussed at stretch that why creditors are important in section 66. Same reason guys, in reduction of capital in section 66, the capital of the company is reducing. Wherever capital of the company reduces, the creditors will become unhappy. So we have to get their consent also. So NCLT will give a notice to creditors also. To all these 4 people, NCLT will give notice, and NCLT will tell them, if you have any objections, send us the objections. We will not use the word objection, we will use the word representation. So NCLT will tell these 4 people that this is the reduction of capital that is being proposed by the company. If you have any representation, send the representation within 3 months. Now if these 4 people are not sending any representations, okay, then NCLT will assume that they are not having any objections, and NCLT will go ahead with a reduction. So if they have representations, they should send, because if they don't send representations, NCLT will assume that these 4 people don't have any objections. Okay, but with respect to creditors, here we have a special point. From creditors, either we have to get their consent or we have to discharge them, which means repay them, or we have to give them security. For creditors, the rule is a little strict. Either somehow get their consent or discharge them or get security. So once these 4 people are settled, once they are happy, then NCLT will now be worried about the accounting treatment. So auditor will give a certificate saying that the proposed accounting treatment is as per the applicable accounting standards. That auditor certificate the company will file with NCLT. Now NCLT will pass an order confirming the reduction, telling the company, yes company, you can go ahead with the reduction. But the process doesn't end here. Company will have to file with the ROC a copy of NCLT's order confirming the reduction. Company will also have to file with the ROC minutes which are approved by the NCLT. Then ROC will register these documents and ROC will also issue a certificate in this regard. And finally, we had learned that after all this is done, company will have to publish in newspapers 2 things. Number 1, the fact that company did this reduction process, and number 2, the reason that why did the company do this reduction process. Then we learned that where it has to be published, in which newspaper, within how much time. Companies Act is not saying all that. Companies Act is giving power to NCLT. That NCLT, when you give the order, no, in the order itself you have to mention that where should the publication be made, in which newspaper, when should it be made, how many times, all that NCLT will mention in the order itself. So this was the whole process, guys. Company will give application to NCLT, NCLT will give notice to 4 people, these 4 people will send representations within 3 months. If they don't send representation, it is as if they don't have objection, but creditors special treatment, either get their consent or discharge them or give them security. Then after all of this, the auditor will give a certificate saying that accounting treatment is as per applicable accounting standards. Then NCLT will pass an order confirming the reduction. Company will file documents with ROC. Company will file 2 things with ROC within 30 days. Number 1, NCLT's order, copy of that, and minutes approved by NCLT. And finally, company will have to publish the reasons for the reduction and also the fact that the reduction happened. Both both company will publish where, how many times, in which newspaper, all that NCLT will mention in its order. So this was the whole process of reduction. Then we learned that in all of these 6 situations, yes, no doubt, some form of capital is getting reduced, but section 66 will not apply. Surrender of shares, forfeiture of shares, diminution of shares, nothing but cancellation of shares. Remember we spoke about this in section 61. So section 61 will apply, don't apply section 66. Redemption of preference shares, section 55 will apply, don't apply section 66. Then purchase of shares of a member by an order of the court, apply the court order, don't apply section 66. Buyback of shares, even here capital reduces, apply section 68, don't apply section 66. Coming to the next section now, section 67. Section 67 is a small, simple, sweet little section sandwiched between 2 big ones. Section 66 on one side, section 68 buyback on another side. In between we have a cutie little section which very often gets compromised, but you will not compromise. Listen to me everybody. Sit up straight and listen. Don't lose your patience. We are almost towards the end. We are almost coming to an end. Listen. So section 67 puts 2 prohibitions, guys. Prohibition number 1, section 67 says that any company, every company, you cannot buy your own shares. Reliance can't be its own shareholder. So point number 1, company, you cannot purchase your own shares. The second prohibition is only for public company. That public company, you cannot give financial assistance for purchase of your own shares or for shares of holding company. But there are 3 exceptional cases. In these 3 exceptional cases, even public company can give financial assistance. What are the 3 cases? Number 1, banking company can give a loan in ordinary course of business. Now even if the borrower uses that loan to buy the same banking company's shares, then it will not be considered as a violation. It is allowed because the banking company has lent loan in the ordinary course of business. But if the banking company lends loan for the purpose of purchase of its shares, that will not be ordinary course of business. That is not allowed. Okay, so banking company is giving loan in ordinary course of business and the borrower happens to use that loan to buy the same banking company's shares, it is not a violation. But if the banking company is giving loan for the purpose of purchase of its shares, that is going to be a violation. Then the second exception, public company can give financial assistance for purchase of fully paid up shares. Whose shares? Its shares or holding company's shares. To whom? To trustee. Trustee means who is a beneficiary? The employees. But for this, prior SR is to be passed. So in the second part, the public company can give financial assistance for purchase of its shares or its holding company's shares to the trustee for the benefit of employees provided a prior SR is passed. In the third exception, company is not giving to trustee for benefit of employees. In the third part, company is directly giving the loan to employees. Which employee? Any employee other than director or KMP. How much loan company can give maximum here? 6 months salary. Understanding? So the company can give loan to employees other than directors or KMP to purchase fully paid shares of the company or holding company, but not more than 6 months salary of the employee. Okay, now coming to the next point, section, we just said that the financial assistance cannot be given by public company, which means it can be given by private company. It can be given by which private company? You're listening to me. Financial assistance, we said, can't be given by public company. To purchase its own shares, public company cannot give financial assistance, which means it can be given by private company. So it can be given by which private company? Only that private company which fulfills 4 conditions. Condition number 1, no default in filing financial statements annual return. Condition number 2, no other body corporate should have invested in this company's shares. Number 3, borrowings from 3 people, banks, financial institutions and body corporates should not exceed the limit. What is the limit? 2 times of paid up share capital or 50 crore, whichever is less, and no subsisting default in repayment of the borrowings. Try to recall Jan 25 question paper question on this section 67 we had worked out as well in class, exactly targeting this point. So yes, financial assistance cannot be given by public companies, which means it can be given by private companies. It can be given by those private companies which fulfill these 4 conditions. Okay guys, simple section 67, 2 prohibitions. Prohibition number 1, company you can't purchase your own shares. This prohibition is for every company. Then prohibition number 2, public company, you cannot give financial assistance for purchase of your shares or for the purchase of shares of your holding company. But 3 exceptional cases where even a public company can give financial assistance. Number 1, banking company is giving loan in ordinary course of business. Number 2, public company can give loan to a trustee for purchase of fully paid shares of the company or holding company for the benefit of employees, but this should be supported by a prior SR. Third exception, company can give loan to employees other than directors or KMP up to 6 months salary for the purchase of fully paid shares of company or holding company. And then finally we learned that yes, private company can give financial assistance, but which private company? Only that private company which fulfills all of these conditions. Okay. Then coming to buyback, section 68 and section 69, and the last part will be section 70 as well. So buyback of securities, we'll go through the points one by one. Point number 1, if the company wants to buy back securities, from whom is the company going to buy back? Company can buy back from the existing shareholders on a proportionate basis, like what TCS did, or company can buy back shares from the open market, which means company can go to the open market and whoever is willing to sell the shares, company can buy the shares from all the persons who are willing to sell the shares till the company reaches a certain target. Like company will go with the target, I want to buy back 5,000 shares. So till the company reaches the target, company will keep buying the shares from whoever is willing to sell the shares. That is from the open market, or company can buy back shares just from the employees. How did employees get the shares? Either through sweat equity or through ESOPs. So point number 1, company can buy back securities from whom? Either from the existing shareholders on a proportionate basis or from the open market, or company can buy back securities back from the employees who got shares either through ESOPs or through sweat equity. Then we learned to buy back, company needs money. So company will take money from where? Company, you have 3 options. You can take money from free reserves, from securities premium, or you can make a fresh issue of shares and take money from that. But you cannot take money out of earlier issue. You can take money out of fresh issue. Then we learned whatever money company takes from these 2 boxes, free reserves and securities premium, we'll see how much money company took from here. Using this much money, how many shares company bought back? That many shares into face value, company will transfer into CRR. Same thing we had even in section 55, redemption of preference shares. But there we see only how much money company took from free reserves. We don't see the securities premium bucket, because over there securities premium money you can use only to pay premium on redemption. Here there is no restriction like that. So we will see how much money company has taken from both these boxes put together. I am not saying transfer that much money into CRR. No. Using that much money, how many shares company bought back? That many shares into face value. That is what will be transferred into CRR. Try to recall the numerical question we did on this point. Okay. Then after this we had learned, if the company wants to buy back, it has to be authorized by AOA, and then board resolution is required. SR is also required. But SR is not required in every case. If the company is spending on buyback not more than 10% of paid up equity capital plus free reserves, if the company is spending not more than this much money, then just BR is enough, SR is not required. But if the company is spending more than this much, then SR is required. But maximum how much money company can spend? Maximum company can spend 25% of paid up share capital plus free reserves. In buyback, wherever we talk about free reserves, even securities premium will come into the picture. Now for this BR-SR point, I will once again draw the diagram for you which I drew for you in the class as well. See, I told you 0 to 10% of paid up equity share capital plus free reserves plus securities premium. If the company is spending not more than this much, if this is all the money that the company is spending, if the company is spending in this bracket, then company you just have to pass a board resolution. If the company is spending more than this, company you have to pass BR, you also have to pass special resolution. But maximum how much company can spend? 25%. 25% of what? Paid up share capital plus free reserves plus securities premium. The point to be noted is, for BR, the limit is paid up equity share capital. But total amount that you can spend, there the limit is paid up share capital. Tiny point guys, not tested till now much in the exam. Be careful with all these little points. Okay. So if the company is spending up to 10% of paid up equity capital plus free reserves plus securities premium, BR alone is enough. But if the company is spending more than 10%, SR is also required. But how much maximum company can spend? Maximum company can spend 25% of paid up share capital plus free reserves plus securities premium. And maximum how many shares the company can buy back in a year guys? 25% of total paid up equity share capital. And after buyback, debt can be more than equity, but debt should not be more than 2 times of equity. Debt by equity should be less than or equal to 2. And when you're calculating the debt equity ratio, equity will mean paid up share capital plus free reserves plus securities premium. So this was our 3 limits guys. First of all, how much maximum the company can spend on buyback? 25% of paid up share capital plus free reserves plus securities premium. Then limit number 2, how many shares company can buy back maximum? Maximum company can buy back 25% of the total paid up equity share capital. And number 3, after buyback, yes, debt can be more, equity can be less. But it can't be like debt is very high. Debt should not be more than 2 times of equity. So debt by equity should be less than or equal to 2. It should not be more than 2. When you're doing this debt equity calculation, remember this calculation is done post buyback. And also remember, equity, the denominator will be equity share capital plus free reserves plus securities premium. Okay. Then after this, we spoke about the explanatory statement. We discussed that when the company is doing a buyback of securities, SR is to be passed. To pass the SR, company has to call a meeting. To call the meeting, company has to send a notice. Now to that notice, company will attach an explanatory statement, and in that explanatory statement, company will put 5 things. The hint to remember is stand. S for which shares, which securities is the company buying back, time limit within which the buyback will be completed, amount which the company is going to spend on buyback, necessity, need for buyback, and disclosure of all material facts. Then before buying back, the securities have to be fully paid up, only then the securities can be bought back. This fully paid up point, where and all we have seen, tell me. Number 1, only fully paid up shares can be converted into stock. Number 2, when we are redeeming the preference shares, before redeeming they have to be fully paid up, only then we can redeem them. Then number 3, bonus shares. Before we issue bonus shares, those shares should be, the existing shares should be fully paid up, only then we can issue bonus shares. And number 4, when we are buying back the shares, before buying back they should be fully paid up, only then we can buy back. So in your one share capital chapter, in 4 places you are finding this one condition of fully paid up. Learn like this guys, make lists like these. As many lists as you can, make them. Makes revision much easier day before the exam. Then, if the company is a listed company, of course, SEBI regulations also have to be followed. If you've understood till here, the process for buyback, this part onwards, let me take you directly into the classroom modes. We'll revise it from there. Yeah, so let's discuss the process from here. Whatever points we've discussed till here, I'm hoping you're clear guys. We spoke about the contents of explanatory statement, the limits, and we discussed if the company is a listed company, company has to follow SEBI regulations as well. Now come to the process guys, let's focus on the process. So first of all, company will prepare a document for buyback. The document is called letter of offer. For whenever the company is making a public offer, company prepares a document called prospectus. In private placement, the document is called POCA, private placement offer cum application. In rights issue and in buyback, in both the document is called as letter of offer. So company will prepare letter of offer in form number SH8 and file it with ROC. Okay, now from that date, the clock will start ticking. Within 20 days itself, company has to dispatch the letter of offer to shareholders. Remember, this 20 days is the maximum time limit. Within 20 days itself, it has to be dispatched to the security holders. Once it is dispatched to the security holders, the buyback offer period will open. It will remain open for a certain period. So let's say this is a buyback offer open date and this is a buyback offer closing date. Now in between, what will the time gap be? The time gap can be anywhere between 15 days to 30 days. Okay. Then after this, we learned that in this offer period, the shareholders are offering their shares for buyback to the company. So when the shareholders are offering the shares for buyback to the company, sometimes there is oversubscription. Like in TCS, I told you, it was 6 to 7 times oversubscribed. Oversubscription means, see, to understand oversubscription and to understand the next point, first of all you have to understand that this SH8, this letter of offer that we are talking about, is an invitation to offer. It's not an offer. Through SH8, the company is telling the shareholders that, see, I'm willing to buy back shares, and at this much price I will buy back shares. Let me know if you want to offer your shares for buyback. So SH8 is only an invitation to offer. Then in this period, when the buyback offer is staying open, in this period the shareholders will offer for buyback their securities. Okay, so it is the shareholders who will give an offer to the company that, company, listen, we will offer these many shares for buyback. Alright, now sometimes what happens is the shareholders offer too many shares for buyback. Like when TCS buyback happened, I was showing you how per share around 600 rupees profit the shareholders could have made if they offered the share for buyback. So sometimes when the shareholders are offering their shares for buyback, they offer too many shares. Oversubscription happens. When oversubscription happens, that is where this next step, acceptance ratio, comes into the picture. The company accepts the offer of the shareholders on a proportionate basis. So this is what my next point is. When the number of securities which is offered for buyback by the shareholders is more than the number of securities which the company wants to buy back, in that case, company will come up with an acceptance ratio. Company will accept the shares offered for buyback on a proportionate basis. Okay, so SH8 is an invitation to offer. I'm just connecting Companies Act with Contract Act over here because this is a language which you understand very well. So through SH8, company is telling the shareholders that, see, I'm thinking of buying back shares, and this is the price at which I'm going to buy back shares, and totally this many shares I want to buy back. If you're holding 10 shares, you can offer 5 shares to me for buyback. Like that, company will prepare SH8 and give to the shareholders. Then the buyback offer period will open. When the buyback offer period is open, it will stay open for minimum 15 days, maximum 30 days. The time limit will be written in SH8 itself. In that period, the shareholders will offer their shares for buyback. Sometimes they offer too many shares. Sometimes when the shareholders are offering their shares for buyback, it results in an oversubscription of the buyback offer. So when that happens, the company will accept the shares for buyback only on a proportionate basis. Got it, guys? So nothing much, very easy only. If you remember it this way, this invitation to offer this way, if you remember, you will definitely not make a mistake. So therefore, coming back to the process now, company will prepare letter of offer in form SH8. The company will file it with ROC first. Within 20 days from that date, company will dispatch it to the shareholders. That day, the buyback offer period will open. It will remain open for a certain period. This period shall not be more than 30 days. It shall not be less than 15 days. In this period, the shareholders will offer their shares for buyback. If the number of shares which the shareholders have offered for buyback is more than the number of shares which the company wants to buy back, then the company will buy back your shares on proportionate basis only. Okay. Then look at this next part, guys. This straight away come over here. Once this, I already told you, letter of offer, once it is filed with ROC, within 20 days, company will dispatch it to the security holders. Now that is the day when the buyback offer will open, and it will stay open for a certain period. So till here you understood. Now once the buyback period closes, listen carefully, this is where the next point is. So once a buyback offer closes, within the next 15 days, company will verify the buyback offers received. What is this buyback offer received? I just told you, right? The shareholders will send their offer to the company that how many shares they are willing to offer for buyback. So company will verify the buyback offers received from the shareholders. Now either the company will accept the buyback offer and company will buy back the shares, or company will reject the buyback offer. If the company is accepting the buyback offer, it means company saying, okay fine, I'll buy back your shares. So company will send buyback price to those shareholders within 7 days. But if company is rejecting the buyback offer, then the company will send refusal notice within 7 days. So once a buyback offer closes, within the next 15 days, company will verify the buyback offers received. Either the company will accept those offers or reject those offers. If the company is accepting the buyback offers, company will buy back the shares and send the buyback price to the shareholders within 7 days. If company is rejecting, company will send refusal notice within the next 7 days. Now what if the company is not sending refusal notice? If company doesn't send refusal notice, it is assumed as if the company has accepted the buyback offer. Okay. Then after this, our next concept is about declaration of solvency. This is an important point I told you. Through the declaration of solvency, we are giving some sort of assurance to the creditors that creditors, yes, we know we are not repaying you, and without repaying you, we are returning the money back to the shareholders. But don't worry, creditors, we have done a good inquiry into the affairs of a company, and company has enough money for you also. So on that note, one declaration will be given. So in this declaration, two things will be written. Number one, board has made a full inquiry into the affairs of the company, and on the basis of the inquiry, board is of the opinion that the company is capable of meeting its liabilities and company will not go insolvent at least for the next 1 year. So don't worry, creditors, we have enough money for you also. That's the whole context of this declaration. This declaration has to be filed with both ROC and SEBI. We will file it with SEBI only if the company is a listed company. This declaration will be in form SH9. It has to be signed by at least 2 directors, one of whom will be managing director. Then we learned that the company has to maintain a separate register of buyback in form SH10, which will contain all the details about the buyback, like how many shares the company bought back, at what price, why did the company buy back, on which date the company cancelled the shares. All the details about buyback will be written in the buyback register. It will be kept at the registered office in the custody of the company secretary or any other person authorized by the board of directors. Then company has to file buyback return also with ROC or SEBI as the case may be. SEBI if the company is a listed company. This buyback return has to be filed within 30 days of completion of buyback. Now to this buyback return, form SH15 has to be attached, which will be a certificate given by 2 directors, out of which one of will be a managing director. So to the buyback return, a certificate will be attached, a certificate by the directors saying that all the provisions relating to buyback given in the Companies Act, all those provisions have been complied with. So to the buyback return, a certificate of compliance will be attached. Okay, so in the process, what are the points we learned? First of all, we learned that SH8 will be filed by the company with ROC. Then within 20 days, company will dispatch SH8 to the security holders. Then the buyback period will open. Buyback period will remain open for minimum 15 days, maximum 30 days. Time limit and all will be written in SH8. In that period, the shareholders will offer their shares for buyback. Once the period is over, within the next 15 days, company will verify the buyback offers received. Either the company will accept your buyback offer and give you the buyback price within 7 days, or company will reject the buyback offer and give you the refusal notice within 7 days. Then if the number of securities offered for buyback is more than the number of securities which the company wants to buy back, then company will accept your shares offered on a proportionate basis. Then we learned if refusal notice we don't get, it means company has accepted the buyback offer. Then we learned about declaration of solvency. This is to give assurance to creditors that we will not go insolvent, we are capable of meeting our liabilities, we have enough money for you also. Register of buyback will be maintained. Buyback return will be filed with ROC within 30 days of completion of buyback. To the buyback return, one director's certificate will be attached in which the directors are saying that all the provisions given in Companies Act relating to buyback, everything we have complied with. Okay. Then coming to the next part of our buyback discussion, there are some time limits. I have drawn this diagram for you over here. Once the resolution is passed, within 12 months the buyback has to be completed. Same 12 months point we had in sweat equity shares also, guys. There also we said that the resolution, the special resolution will have validity period of 12 months. Within 12 months the sweat equity shares have to be allotted. So here also the resolution will have validity period of 12 months. Within 12 months company should complete the buyback. Once buyback is completed, if the company wants to make another buyback, the time gap between 2 buybacks should be minimum 1 year. Then once the company completes the buyback, the company has to file buyback return within 30 days. Just now we saw, once a company completes a buyback, within the next 7 days the securities have to be extinguished, but this point is applicable only the shares are physical shares. And lastly, once a company completes a buyback, company, if you want to raise funds by issuing the same kind of securities again, if you want to raise funds, you have to wait for 6 months. 6 months cooling period is applicable. In 6 months you cannot issue securities of the same kind. Like company can issue other kind of securities, but once a company completes buyback, for the next 6 months the same kind of securities company cannot issue and raise funds. But in this, by the way, this 6 months period is called as cooling period. Now in this 6 months period, company can issue bonus shares, because through bonus shares company is not raising funds. Company can convert preference shares into equity, loans into equity, debentures into equity. That conversion company can do because company is not raising funds because of conversion. Company can also issue ESOPs. But in these 6 months, you understood what company should not do. In the 6 months, company should not issue more securities of the same kind and raise funds. Okay. Then we learned that section 70 says that this whole concept of buyback, company cannot do any buyback if there's any default relating to deposits or interest, debentures or interest thereon, preference shares or dividend thereon, or repayment of loan, interest thereon. If any of these defaults exist, then company first rectify the default, wait for 3 years, only then you can buy back. Also, if there's any subsisting default relating to annual return, financial statements or dividend, company cannot buy back securities, and company cannot buy back securities through investment companies also. So this was your entire buyback discussion. And now coming to the last concept in your share capital chapter, debentures, covered in section 71. Very simple points, guys. I'll just highlight the main points over here. Debentures are of debt nature. We saw the definition, 2 parts, debentures include and debentures does not include. So what does debentures include? It includes debenture stock, bonds or any other instrument of the company evidencing debt, whether constituting a charge on the assets of the company or not, but does not include those instruments which are mentioned in chapter 3D of RBI Act, like derivatives and money market instruments and all. Also doesn't include those instruments which are prescribed by central government in consultation with RBI. Then for debentures, company will have to issue a debenture certificate within 6 months. This point we already know. Like shares, even over here in debentures also, company has to file return of allotment within 30 days from allotment. allotment, then debentures will carry a prefixed interest rate. They are movable, they are transferable, and they will not have voting right. Then section 181C we spoke about. In section 181C we discussed that there is a limit. The company can borrow maximum how much money? There is a limit. The total borrowings should not exceed paid up share capital plus free reserves plus securities premium. Now borrowings will also include debentures. So company should issue debentures in such a way that the total debentures issued along with the total borrowings in the company is not exceeding the limit. What is the limit? Paid up share capital plus free reserves plus securities premium. Company, if you want to issue debentures for more than the limit, then you just have to pass one special resolution. Then you can issue debentures for more than the limit. Then we had learnt about debenture redemption reserve. Here we said company 10% of the outstanding debentures has to be transferred into DRR every year. There is no money outflow. We are just taking money from one reserve and putting it into another reserve. But in debenture redemption investment, there will be a money outflow. By 30th April of the current year, company should see how many debentures are maturing in the current year. That much amount into 15% company has to take from the bank account and put into debenture redemption investment. So here we said that there will be an outflow. Okay. Then we had learnt about the different types of debentures: convertible, non-convertible, redeemable, irredeemable, secured, unsecured. Redeemable debentures have to be redeemed within 10 years, but same thing, if the money is raised for infrastructure projects, they will be redeemed within 30 years. Then if they are secured debentures, we have to give some collateral, we have to give some asset, but the asset should be enough to meet not only the amount which is due on debentures, but also to meet the interest amount. Then whose asset can we give as security? Company's asset, associate company's asset, subsidiary's asset, holding company's asset, any of these assets we can give as security. But if there are many debenture holders, then this charge will be created, the security will be given in whose favor? See, they are secured debentures, right? So company will create a charge on the assets. Now the charge has to be created in whose favor? If there are one or two debenture holders, we can create the charge in favor of those one or two debenture holders. But if the company is having multiple debenture holders, thousands and thousands of debenture holders, then in whose favor will the company create the charge on the assets if they are secured debenture holders? So that is where the trustee, debenture trustee, comes into the picture. So if they are secured debentures, then company will create the charge in the name of the debenture trustee. He is like a representative of the debenture holders. Then we started learning about debenture trustee. Debenture trustee concept comes into the picture only if we have many debenture holders. If there are few debenture holders, we don't need a representative. When there are many debenture holders, that is when we need a representative. So either the company is making a public offer of debentures, or company is issuing debentures to more than 500 members. That is when the company needs debenture trustee. And the debenture trustee has to be appointed even before the company issues a document, because in the document the debenture trustee's name has to be written. Then debenture trustee has to give a prior written consent that he is willing to be appointed as debenture trustee. Then we discussed who cannot be appointed as debenture trustee. We saw any person who beneficially holds shares in the company cannot be appointed as debenture trustee. Then promoters, directors, KMP, employees, their relatives, then any person to whom company owes money, or any person who owes money to cash, any person who has pecuniary relationship with the company, any person who has given a guarantee to the debenture holders that don't worry, company will repay your debenture money, any person who has given this kind of guarantee, such kind of persons can't be appointed as debenture trustee. Then after this we had learnt if the assets of the company are insufficient to redeem the debentures, then debenture trustee will file a petition to NCLT that NCLT company's asset value is less, liabilities are more. Then NCLT will pass an order asking the company not to take further liabilities. But if the company fails to redeem the debentures or fails to pay the interest on debentures, again an application has to be filed with NCLT. NCLT will order the company to redeem the debentures forthwith. Right? So this was a discussion on debentures. Now listen, before I close this chapter, I just want to give you the sequence. I told you that before I end this chapter, I will tell you in what sequence you should be learning this chapter whenever you do revisions. Always remember this basic rule. You never start with the different kinds of capital and all. Whenever you start a new chapter, your energy level is very high. So you should capitalize that energy level to finish the difficult concepts first, the more important concepts first. So whenever you are learning buyback, you should first finish buyback. Whenever you are doing the share capital chapter, you must first finish buyback. Then you must finish debentures. Then you must finish section 66. Then you must finish section 61. And then you can finish everything else in whatever order you want. Okay, but you should first be doing these 4 things, only then you come to everything else. Understanding, everybody? Finish buyback first, debentures, section 66 reduction of capital, section 61 alteration of capital, only then do everything else. Alright guys, so with this we are finally done with this big lengthy chapter. I am hoping you are as confident as I am imagining you to be. Thank you guys, bye bye.